Good morning everyone, welcome to Weebearn, which helps you grow rich. We are a comprehensive money educational platform dedicated to nurture entrepreneurs, investors, and capitalists among secondary school students. Today is our first live streaming in English, so let me introduce our channels. Weebearn literally means an otaku money-making channel, a platform designed to facilitate financial gain. To help weebs and otakus like me to earn more money and achieve financial freedom. The initial segment of the discussion invites dialogue on data analysis related to profit generation, as well as an examination of financial reports, macroeconomic indicators, technical aspects, and exchange benefits, thereby elucidating pathways to wealth creation and success. The subsequent portion centers on the deployment of Hermes Agent on Tencent Cloud's Lighthouse. It encompasses a guided configuration utilizing Tencent's Cloud Skill Hub, which includes the installation of several tools such as Bankroll, Polyco, Alpaca Trading, On-Chain OS, and Longbridge Skills, all aimed at enhancing financial savings. Furthermore, a brief overview of our financial education offerings within the metaverse, personal development courses, life advisory, and life coaching services offered by Weebearn, the Otaku money-making channel, is provided. Additionally, we are going to introduce our United Empires of Otakus, also known as the Weebearn VTubers Alliance, a decentralized autonomous organization focusing on supporting the development of aspiring virtual idols of the future generations. We encourage participation from interested secondary school students or teenagers looking to embark on a VTuber career. If you are a secondary school student and you're passionate about being a VTuber, join our Weebearn VTubers incubation program and auto agency. In the concluding segment, supplementary insights into harness engineering that were not discussed in the previous day are provided. It is emphasized the whole we are going to systematically organize knowledge regarding the history, core methodologies, and practical experiences of this field, with particular attention given to the lessons gleaned from teams at OpenAI, Anthropic, and Stripe. A cross-comparison of approximately 10 independent information sources has yielded a compilation of recognized phases, ongoing disputes, and potential areas for entrepreneurial exploration. Based on past experience, the discussions aim to encompass a diverse array of resources ranging from philosophical texts to practical trading manuals, all fostering an understanding of interdisciplinary financial theories and foundational wealth-building logic, ultimately guiding you participants toward establishing passive income streams. This broadcast represents the 25th installment of a newly established series titled 毒撚Reading Discussions, signifying a reading group format oriented toward wealth creation literature. The motivation behind initiating this reading club or this reading series parallels the reasons for engaging with artificial intelligence topics. The recognition of a correlation between wealth and reading habits based on statistical studies, coupled with market research revealing growth opportunities for reading discussions among peers within the VTuber industry. I, Weebearn, acknowledge the importance of literature reviews for developing effective monetary strategies, reinforcing the necessity of standing on the shoulders of giants to uncover principles or strategies for financial success. So again, please like, subscribe, and share our channel to your classmate or your schoolmate who love money. Weebearn is a comprehensive wealth management educational platform aimed at nurturing capitalists, entrepreneurs, and financially successful individuals. Lastly, references to pertinent literature, research reports, and articles will be shared in the comment sections for collaborative reading on AI engineering documentation. And feel free to chat anything else, or if you have some nice AI engineering documentation or reading that can boost other audience income, you may also suggest it to me. Let's review again about the context engineering first. Actually, we plan to host a PowerPoint series about context engineering, but in the recent year, another even greater industry, greater idea of harness engineering comes first, has risen, and so let me briefly talk about context engineering before going into the news. In the year 2026, are you still engaged in prompt engineering? It appears that you are already falling behind at the starting line. First, consider a question. If you activate Claude or ChatGPT at input, please help me write a market analysis on Bitcoin. And the AI provides a response that you perceive as tolerable. You might think, this AI is not intelligent enough. However, the actual problem lies not with the AI, but with your failure to provide sufficient context to facilitate a satisfactory response. This distinction represents a crucial skill gap in 2026. One group remains fixated on adjusting prompt text while the other has transitioned to the application of context engineering. The difference between these two approaches is not merely 1/10, but rather a tenfold disparity. In the introductory section, the essence of prompt engineering has not disappeared. It has evolved into a foundational competence, akin not taking pride merely in the ability to type. Prompt engineering teaches us how to enable AI to comprehend our statements, whereas context engineering focuses on a deeper inquiry. How does the AI operate internally prior to generating a response? This inquiry is fundamental to determining the quality of AI output. As Shopify's CEO Toby remarked in 2025, I prefer the term context engineering as it better encapsulates the core competency, providing all the necessary context to AI for effectively resolving tasks. In contrast to prompt engineering, similarly, ex-Tesla AI lead and OpenAI co-founder Karpathy stated, context engineering is a refined art and science, centered around incorporating the right information into the context window to support subsequent actions. The remarks made by these two individuals are not mere coincidence, but rather a shared perspective on the same subject. Anthropic published an engineering column in September 2025, explicitly stating, most developers are aware of prompt engineering. However, unlocking the true potentials of AI agents depends on context engineering. I will systematically isolate the context of context agent. AI's memory exists solely within a specific domain. Many misconceptions regarding AI stem from the erroneous belief that it retains your statements during conversations. However, this is not the case. The only moment the AI acknowledges your presence is within the context window, which encompasses all information available for the AI to reference, before generating each response. Once this scope is exceeded, the AI loses its memory. Consider this analogy. Each interaction with AI occurs on an empty stage. Prompt engineering teaches you how to write the script, your spoken context, whereas context engineering instructs you on how to stage the entire performance, including props, lighting, other actors, and background strips, ensuring everything is set before the initial dialogue. A performance with only dialogue but no well-staged environment will invariably seem mundane. The information contained within the context window includes 6 elements that collectively constitute a comprehensive context: system prompt, conversation history, retrieved documents, tool outputs, memory, and state information. The essence of context engineering is the art of managing these 6 phases. The concept of context rot explains why long-term conversations with AI tend to become increasingly uninteresting. Have you ever noticed a decline in conversation quality during extended dialogues with AI? This phenomenon is not an illusion, but a typical manifestation of context rot. The underlying cause is that the context window has a physical limit. As the amount of information increases, all the information is relegated to the margins, and the AI does not distribute its attention uniformly across the context. It is more sensitive to the most recent and initial information, while intermediate information tends to be overlooked, just like the human neural system. The manifestations of context rot include 4 symptoms: the AI forgetting previous commands, beginning to reiterate discussed topics, a decrease in output quality, and an increase in responses that lack engagement and personality. A high-level context engineer can prevent this situation from arising, as the solution lies in proactively managing the context rather than passively responding to its degradation. The memory architecture discussed is designed to enable the AI to have long-term memory through layered memory management, as in a computer storage structure, utilizing in-context memory, working memory, external memory, long-term storage. and episodic memory, event memory, collectively transforms the AI from a one-time tool into a long-term partner. Again, just like the human psychology. For instance, context engineering became crucial for addressing the AI's inability to understand our writing style and perspectives. The importance of RAG, true invocation and state, compromise the dynamic injection of context. Retrieval augmented generation RAG essentially involves querying data in real time, while true invocation expands the capabilities of the AI. For multi-step tasks, state management ensures the AI comprehends its current position and progress, preventing it from becoming lost during prolonged tasks. Context transmission among multiple agents emphasize that the most significant advancement in 2026 will not merely be at the model level, but rather in the establishment of multi-agent systems and orchestrators. In a highly efficient architecture, it is crucial to have multiple agents working collaboratively rather than a single entity. Let me close my window first because it's raining at my home. It is crucial to have multiple agents working collaboratively rather than a single entity handling all functions. Context engineering focuses on the design of information flow between different agents, ensuring that only the essential information is communicated. A practical action plan for context engineering concentrates on directly applicable template frameworks, include high-quality system prompt structures, standardized protocols to prevent context rot, RAG guidelines, and standard formats for multi-agent context transmission. The market value of context engineering is becoming increasingly evident, as Gartner's 2025 report predicts that this field will rapidly become a standard component of corporate AI infrastructure. LinkedIn data shows that salaries for related positions are significantly higher than those for conventional prompt engineers. Final insights emphasize that 90% of AI issues stem from contextual problems, and the successful design of the background information necessary for AI response is key. While prompt serves as a tactic, context constitutes a strategy. Essentially, individuals proficient in context engineering are pivotal in designing AI systems. Therefore, continuously exploring and refining your context system will undoubtedly be a crucial response for shaping future competitiveness. So, let's brief through the recent market. This is our market miscellaneous and reading miscellaneous program. So basically, we are combining comprehension and all. We are reading the market and also reading some books that are beneficial to our wealth management and wealth growth in our miscellaneous live stream. This week, the cryptocurrency market experienced a sharp decline followed by a weak rebound. Bitcoin BTC temporarily dropped below 60,000 on 5th of June, later oscillating between 62,000 and 63,000. In contrast, Ethereum ETH fell from approximately 1,770 the previous week to a range of 1,640 to 1,660, demonstrating a significantly weaker recovery compared to BTC. Overall, this week reflects a correction after a substantial decline, rather than a trend reversal. The Nasdaq index rose this week by 0.7% to 25,888 points. Key stock movements include Tesla, which increased by 1.8% to 606, and Nvidia, which saw a modest rise of 0.2% to 2,205. On the commodities side, gold fell by 2.6% to 4,239, while cryptocurrencies showed strong gains. Recently, Bitcoin rose by 5.5% back to 64,000, Ethereum surged by 7.6% to 1,680. Despite these gains in certain sectors, US equity valuations remain elevated, and risk persists due to high treasury yields and elevated oil prices. This week, one new stock was added to the portfolio, one existing from an in terms of consumer activity, May's annualized existing home sales reached 4.17 million units, exceeding a forecast of 4.07 million units. Additionally, the preliminary June reading of the University of Michigan Consumer Sentiment Index improved to 48.9, higher than the expected 46.1. While falling gasoline prices provided some relief and boosted sentiment slightly, overall consumer confidence remains subdued. Or let me just share. Maybe I just share screen, okay. From an economic perspective, recent data has been mixed but largely aligned with market expectations. Inflation remains elevated, with May's Consumer Price Index CPI rising by 4.2% year-over-year, matching expectations but exceeding April's 3.8%, marking a 3-year high. Core CPI for May increased by 2.9% year-over-year, also in line with forecast but slightly higher than April's 2.8%. On the producer side, the Producer Price Index PPI rose by 6.5% year-to-date in May, surpassing the expected 6.4% and accelerating from April's 5.7%. However, core PPI growth remains steady at 4.89%, slightly below the anticipated 5.4%. These figures underscore persistent core inflation pressures, driven in part by rising energy and transportation costs, which have led markets to significantly lower expectations for interest rate cuts this year. From a macroeconomic perspective, conditions continue to be restrictive. The Consumer Price Index CPI in the United States rose approximately 4%, indicating persistent inflationary pressures. Geopolitical tensions in the Middle East have heightened oil prices and inflation expectations, leading to increased market anticipation of the Federal Reserve maintaining elevated interest rates for an extended period, thereby steering capital towards defensive strategies. Consequently, although BTC and ETH have shown signs of rebound, they lack clear momentum for sustained continuation. The CoinGlass Greed and Fear Index stands at 13, indicating extreme fear, while the previous value is positive 0. The CMC Fear and Greed Index is at 15, signifying extreme fear, whereas the previous value is negative 3. Bitcoin's dominance is recorded at 58.98%, similar to previously the 58.37%. And as shown in the you may see that the coming S&P Global US Manufacturing PMI and then Global Service PMI. Okay, now let's consider the exchange traded funds data. I think the internet was disconnected. Okay, so let's view the exchange traded fund. The performance of exchange traded fund ETF investment this week was varied. BTC ETFs saw a net outflow of approximately 708 million, with outflows of 326 million on 5th of June and 214 million on 10th of June, suggesting that institutional buying power remains relatively weak. The capital flow for BTC exchange traded funds ETFs remains comparatively weak, although the outflow has narrowed relative to the previous week. From 4th of June to 10th of June, the total net outflow was approximately 705 million. Specifically, an outflow of 326 million occurred on 5th of June, followed by a further outflow of 240 million on 10th of June. Despite a slight net inflow on 4th of June, this was insufficient to reverse the overall trend of capital outflow, indicating that institutional demand remains limited. Conversely, in contrast, Ethereum ETFs exhibited a relatively stable performance compared to BTC, with a modest net inflow of about 19.3 million during the period from 4th of June to 10th of June. Notably, a single-day net inflow of 82.4 million on 8th of June saw a singular net inflow. This temporarily improved market sentiment. However, subsequent outflows of 40.8 million and 35.5 million took place on 9th of June and 10th of June respectively. Therefore, while ETFs did not display significant capital depletion, the inflow strength remains insufficient to facilitate a meaningful rebound on ETH. Therefore, the ETFs were largely flat, indicating a lack of definitive financial support. The relative unrealized profit (RUP) serves as a periodic indicator for assessing the overall profitability of the market. Never mind. Historically, during each major market bottom for Bitcoin, the RUP relative unrealized profit has consistently fallen within the range of 0.3 to 0.38. Last week, when Bitcoin dropped below 60,000, it reached a low of 0.351, officially entering the bottom region. By integrating the RSIP signal below 50% with the deep bear valuation model, multiple on-chain indicators converge towards the same conclusion. The market is nearing the bottom of the bear cycle. A decline to the coin time price, approximately coin time price is time weighted average price. You may consider, just like T-ball. But it is a on-chain indicator, so it records each transaction's timestamp. So according to a decline to the coin time price, approximately 55k to 60k, this would be even more favorable. Maintaining patience is advised as the dawn is approaching. So this week's most thrilling news is that SpaceX has moved forward with a IPO representing approximately 5% of its ownership. The IPO itself is only 75 billion. So this infers a valuation of around 1.75 trillion valuation. This development may prompt investors to liquidate other holdings to raise capital for participation. For those not aiming for short-term speculative gains, it is advised to avoid chasing FOMO at elevated levels. A more prudent approach would be to wait for a bear market to establish positions. The ongoing US-Iran tensions could contribute to prolonged inflationary pressures. Consequently, market sentiment around interest rate cuts this year remains pessimistic, and profit-taking activities have intensified. Meanwhile, sectors with relatively lower price-to-earning ratios, such as consumer staples and healthcare, are attracting increased investor interest. Although former President Trump has announced progress toward an agreement to end military actions, significant uncertainties remain, and it is unlikely that such promises will materialize in the near term. Iran's blockade of the Strait of Hormuz has driven up prices for key commodities like oil, fertilizers, and chemicals. Even if peace is achieved in the Middle East, it will take several months for global supply-demand dynamics and price stability in goods and services to normalize. SpaceX has achieved a historic milestone by completing the largest IPO ever, with its shares rising 19% on the first day of trading. The company closed with a market valuation of approximately $2.1 trillion, elevating it to the position of the sixth most valuable public company in the United States. This development has also made Elon Musk the world's first trillionaire. The stock price surged from its initial offering price of $135 to $161, 11 by the end of the trading day. The IPO has had widespread implications across the financial sector. Lead banks, including Goldman Sachs and Morgan Stanley, are set to earn $100 million each, while Bank of America, Citigroup, and JP Morgan Chase are expected to generate around $75 million each from the deal. Additionally, retail investors and even competitors stand to benefit from the momentum created by this landmark event. Analysts suggest that SpaceX's successful debut could have paved the way for other high-profile companies, such as OpenAI and Anthropic, to pursue their own public listings in the near future. The cryptocurrency sector has experienced a significant collapse, resulting in widespread financial losses among participants in the tokenized tokenized stock. Numerous exchanges attempted to leverage their allocation for the SpaceX IPO to attract investments from individuals in the on-chain market. However, a considerable portion of these individuals invested funds to secure allocations. Yet upon completion of the offering, they were informed that no allocations were available, and refunds will incur substantial fees. The situation became even more dire for some participants who observed a notable increase in pre-market contracts for SPCX. In anticipation of profits, they engaged in short selling to hedge their position, but ultimately faced losses on the short positions while failing to acquire the IPO shares. This instance has severely undermined the narrative surrounding real-world asset RWA tokens that have been promoted within the crypto community for several years, leading to diminished trust in the validity of stock tokens offered by exchange. In summary, the cryptocurrency market has been exploited in three significant ways. The first exploitation occurred when exchanges claimed to facilitate the purchase of SpaceX IPO shares, prompting many to pay for allocations only to discover they received none and face extensive refund fees. The second exploitation involved individuals who, driven by the rising pre-market prices of SpaceX, incorrectly assumed profits were guaranteed and shorted to secure those profits, which resulted in losses on their short positions alongside the failure to obtain IPO shares. The third exploitation effectively discredited the long-promoted concept of real assets on the blockchains. The RWA narrative or RWA industry, resulting in a loss of credibility for tokenized stock marketed by exchanges. This week's market sentiment resembles a roller coaster, as investors observed a brief uptick just to face a significant decline the following day, followed again by rebound. Such frequent fluctuations have left many investors being exhausted. Weebearn Otaku Research Institute operates on a community model. To receive updates and achieve success together, consider subscribing me and also joining our Discord community. So I've already dropped our Discord community link in our comment section. It is, in all honesty, impossible for anyone to accurately predict the detailed direction of the market in the short term. Nevertheless, I'm steadfast in my belief that the prevailing theme in the market continues to revolve around shifting interest rates. Anticipation surrounding the upcoming FOMC meeting and clearer guidance from Walsh will likely perpetuate this prevailing sense of uncertainty. This context explains my motivation for particularly drafting an in-depth analysis this week, aimed at helping our audience and our community members navigate through the current fog of macroeconomic data to discern the underlying fundamentals, rather than being swayed by random market fluctuations as noises. An unprecedented speculative sentiment has manifested in the market. The trading volume of ETFs and indexes serves as a critical parameter for assessing the subsequent trajectory of the market, representing a key gauge of present market sentiment. Over the past 2 weeks, there have been consecutive occurrences of historical pivotal events. Specifically, the trading volume of put options on S&P 500 SPX reached an all-time high last Friday on the 5th of June 2026. And also SOXS, the semiconductor 3x inverse ETF, recorded a single-day volume exceeding 1.36 billion shares, marking it as the third highest single-day trading volume for any US-listed ETF in the past 2 decades. In contrast, its usual average daily volume hovers around 200 to 500 million shares. Therefore, this instance represents approximately 3 times the typical volume. Elevated trading volumes typically indicate that a significant number of traders are actively engaging in short selling or hedging against potential declines in the semiconductor sector. Additionally, this suggests higher odds that current buying pressure may not match the intensity seen in previous rallies. Further analysis includes bullish and bearish positions on S&P 500 ETFs, such as SPXL, SPXS, SOXL, alongside the ETF mentioned SOXS. The trading volume of these funds have surged more than 1,000% since the beginning of this year. On 5th of June, the SPX options trading volume consisted of 64% in 0DT, 0 days to expiration contracts, indicating that traders are inclined to engage in short-term hedging or speculative activities. This is a contributing factor to the assertion that the current market speculative sentiment is at its highest in history. The components of the SOXX ETF include Micron Technology, Advanced Micro Devices, Broadcom, Marvell Technology, Intel, Nvidia, Applied Materials, Qualcomm, Texas Instruments, and NXP Semiconductors. In this prevailing environment, it is evident that there is not significant opportunity for frequent trading. I maintain that as long as one has ensured that one's own investment portfolio is in a healthy state, specifically by clarifying core and satellite assets, ensuring the absence of leverage and maintaining sufficient profit buffers, then the best course of action may often be to refrain from operating. This is one of the rationale of a so-called long-term investment, or hold on your dear life in general. In this, I maintain that that during this period of awaiting market clarity, we have more opportunity to reflect on the significance of the formal existence. I am particularly enthusiastic of the following positive cycle manifested by the current iteration of our Weebearn Investment Research Institute. My initial intention was to produce better analysis to attract and gather like-minded readers and investors who value our minds. The empirical evidence suggests that high-quality content or like anime and some innovative virtual idol model indeed draw an audience of exceptional caliber, and so we are currently trying our best to incorporate more and more 3D technologies, 3D modeling technologies, VR technologies, and we are also recruiting secondary students to become our partner and make Weeps great again, or make Otakus great again. Human cognition has its limitations from according to neuroscience, with each individual necessarily possessing unique blind spots. However, with an increasing array of professionals from diverse fields, professional weebs on otakus in our community engaging in discussion, hopefully the insights generated within our group often leave me astounded. Each day within our Weebearn community, I acquire fresh perspectives and faster insights into entrepreneurship ideas, startup trends, and industry trends. Most gratifyingly, our discussions centered not only on the mere chase of stock tickers, but rather on exploring industry logic, fundamental changes, and understanding business models. We engage in an exchange regarding the world we comprehend, rather than fixating merely on stock price movements. It is precisely due to the ensemble of individuals passionate about critical thinking that our Weebearn Research Institute genuinely functions as an institute. Our anime and gaming community embodies two core values. The first being my delivery of in-depth analysis for getting rich, and the second being a high-quality space and an atmosphere for the exchange of divergent ideas. Let's transform from a unilateral output into a platform for collective intelligence and shared learning, which is, as my reading club毒撚 suggested, and in the interdisciplinary approach in wealth generation. I particularly encourage those members who have yet to utilize the chatroom resource. Please take full advantage of this opportunity and feel free to share your ideas. And this is also a manifestation of the spirit of freedom of speech in our capitalism, as suggested from the book Capitalism and Freedom. Freedom of speech is one of the most significant values in our capitalism. In a volatile market, it is easy for one to become influenced by emotions when fighting alone. However, within a community conducive to rational discussion, one finds that a deeper understanding of the industry enhances resilience against fluctuations. Investing is akin to a long-distance racing, and the wisdom of the collective serve or a voyage, a startup voyage, and the wisdom of the collective serves as our most effective refueling station. And besides SpaceX, we are also going to talk about the WWDC APL, and also the financial report revealed from Oracle. If one were to inquire with any trader at the beginning of this year regarding the Federal Reserve's subsequent actions, the response would almost uniformly indicate a preference for interest rate cuts. At that time, like in January, the federal funds futures indicated the anticipation of 2 to 3 rate cuts within this year, and Wall Street research reports predominantly featured themes of soft landing and looser monetary policy on the horizon. The market operated as a self-reinforcing mechanism. When consensus aligns amongst participants, prevailing narratives can devolve into entrenched beliefs. This is one of the rich mindsets from our mindfulness. Okay, it's raining in Hong Kong, and the wind blows open my window, so I have to close it again. Because I want to partially open my window to allow ventilation and oxygen supply, fresh oxygen supply. Where were we? Oh, okay. Now let's continue talking about the interest rate. Okay. And as one of the most fundamental rich mindset, the market operates as a self-reinforcing mechanism. When consensus aligns amongst participants, prevailing narratives can devolve into entrenched beliefs. However, within a span of less than a quarter, this mechanism subtly and yet completely shifted direction. Upon reviewing the CME's Fed Watch, let me introduce you to one of a platform where you can learn or read some data for making money. This is the CME group, the Chicago. No. CME Fed Watch, yeah. And here you can view all the target rates and the probability of each target rate. And also another more accurate consideration is the Holy market, of course. Nowadays, the probabilities inferred by Holy market is very accurate. In terms of elections and politics, the traded probability is more accurate than those so-called surveys and questionnaires. And upon reviewing the CME's Fed Watch, one can observe a scenario that was scarcely considered 3 months prior. An increasing amount of capital is beginning to price in potential rate hikes before the year's end, with probabilities for a December increase. This one. With probabilities for December increase even reaching 70%, I think, or 60%. What prompted this shift? The initial factor was the notably robust non-farm payroll report on 5th of June, last Friday. And the second factor is the persistent inflation that refuses to recede. Also, the third factor is the change in leadership at the Fed. While I do not possess clairvoyance and no individual can entirely predict the trajectory of interest rate and market movements, I'm confident that after engaging with this analysis, we may gain a clearer comprehension of the current macroeconomic data. Subsequently, with the emergence of new data, just like in Bayesian statistics or Bayesian inferencing, you may be better discern whether such information alters the current understanding, which is your prior distribution. Whether market reactions are excessive or if they warrant closer scrutiny. Before delving into an analysis of various economic indicators, it is essential to establish a common framework. Many individuals interpreting macroeconomic conditions tend to fall into a phenomenon known as data reflexivity, where favorable employment numbers intuitively lead to optimism projections, while rising inflation prompts a corresponding bearish sentiment. However, individual data points carry market different ways at different points in time. Absent an underlying framework, data merely manifests as random noise. Only with a structured framework does data reveal the trajectory of monetary policy. This framework is defined by the Federal Reserve's dual mandate and the authoritative body responsible for executing this mandate, the Federal Open Market Committee, FOMC. The US Congress has mandated the Federal Reserve with two primary objectives: maximum employment and price stability. These dual goals constitute a balance that must be regularly maintained. William McChesney Martin, the longest-serving Fed chairman in history, articulated a famous metaphor describing the role of a central bank as akin to the person who takes away the punch bowl just as the party gets going. In this metaphor by William Mackenzie Martin, the Federal Reserve is in the position of the chaperone. When the economy overheats and inflation rises, the Fed must increase interest rates to cool the economy. Conversely, when economic activity weakens and joblessness rises, it has to inject liquidity to stimulate growth. Historically, these two objectives have often coexisted harmoniously. During periods of moderate economic growth, a healthy labor market and inflation trapped within a targeted range. Both sides of the balance serve their respective roles, permitting the Fed to maintain the status quo. However, this balance faces its sternest test during periods of conflicting objectives. A notable historical precedent occurred in the 1970s, when the US experienced stagflation marked by inflation rates soaring into double digits while unemployment remained stubbornly high. In this scenario, both ends of the balance were destabilized, pointing towards entirely opposing monetary policy paths. To save jobs, interest rates would need to be cut, potentially exacerbating inflation. And alternatively, raising rates to curb inflation would likely worsen unemployment. Chairman Paul Volcker ultimately made the excruciating choice to wholly lean towards the price stability side, aggressively raising the federal fund rate to extreme levels, deliberating plunging the US economy into recession as a price to finally subdue inflation. This historical account emphasizes that when the dual mandate comes into conflict, the Fed must balance and weigh the consequences, of which discomfort is more intolerable at that moment. With an understanding of this decision-making logic, we can perceive the essence of the current situation. In recent times, the crux of the market's debate revolves around whether the Federal Reserve will first observe a failure in the employment market that prompts a rate decrease, or whether it will be forced to maintain high rates due to persistently high inflation. At this moment, one side of the balance is indeed steadfast. The US labor market has exhibited remarkable resilience. Although it is not as overheated as in previous years, it has not indicated any recessionary signs necessitating urgent monetary policy intervention. This understanding is pivotal in comprehending the current policy shift. With the employment lag of this dual mandate standing firm, the Fed has lost the rationale for hastily lowering rates to prevent a recession. On one side is an employment market that generates no concerns, while on the other is inflation exceeding target levels. This circumstance erodes the Fed's flexible response function, compelling policy balance to tilt towards a hawkish stance. At the beginning of this year, the market broadly speculated on rate cuts, largely anticipating that a weakening employment market would precede and necessitate a Fed pivot. However, as robust employment data continues to emerge, this premise is rendered invalid. As such, when strong jobs reports are released, market reactions have been negative. Within the current policy framework, strong employment data is no longer an indicator of economic prosperity, but has rather become a foundation for the hawkish stance to maintain high rates or even to tighten further. To understand how this balance is manipulated, we must orient our focus towards the decision-making roundtable that determines global pricing for capital, the Federal Open Market Committee. The voting structure of the FOMC represents a sophisticated exercise in political compromise. This roundtable encompasses 12 voting members. 7 members of the Board of Governors in Washington possesses permanent voting rights. The President of the New York Federal Reserve holds a permanent seat due to overseeing market operations, while 11 regional Federal Reserve Bank presidents rotate, sharing 4 voting slots annually. The design of this structure aims to balance the political will emanating from Washington with the actual economic pulse from various regions across the country. Historically, the FOMC has pursued consensus rather zealously. The central bank's most potent tool is not the interest rate itself, but rather its credibility. Any dramatic disunity within the decision-making body would induce market skepticism regarding policy direction, leading to volatility in both the bond and equity markets. Consequently, in recent times, the FOMC's decisions have typically exhibited significant uniformity. Even amidst intense internal debates, once it reaches the final voting phase, members generally opt for compromise and cast votes in favor to project an image of a unified, flawless Federal Reserve. In the majority of meetings, dissenting votes typically amount to 0 of 1, with 2 votes being a rarity. However, the carefully cultivated consensus politics has unraveled over the past 6 months. This division first became apparent during the interest rate meeting held at the end of last year. Although the committee designed by majority vote to reduce rates by 25 basis points, a rarely 3-way split emerged. Board member Stephen Maran cast a dissenting vote, advocating for a more aggressive reduction of 50 basis points. Simultaneously, 2 region presidents, Kansas City and Chicago, voted against any cut, asserting that interest rates should remain unchanged. By April of this year, the divisions have become even more pronounced. The FOMC ultimately resolved to maintain rates, producing a voting outcome of 8 in favor and 4 against. The 8-4 vote recorded the most diverse result since 1992, over 30 years ago. 3 regional presidents, Cleveland, Minneapolis, and Dallas, vehemently opposed the inclusion of any language suggesting a future possibility of rate cuts in a policy statement. They argued that continuing to signal rate cut expectations amid persistent inflation was exceedingly perilous. This unprecedented level of conflict reflects fundamental divisions within the decision-making body across 3 dimensions. Firstly, the ineffectiveness of theoretical models, academic disunity. Classic inflation forecasting models, such as the Phillips curves, have utterly failed. Those argued that inflation stems from the supply side, rendering high interest rates impotent in addressing the issue. Hawks firmly believe that strong employment indicates a significant elevation in a neutral interest rate. Without maintaining tightening, inflation risks a resurgence akin to the 1970s. Secondly, disparities between Washington and local conditions, which is the interest-based disunity. Governors in Washington face direct political pressures and congressional questioning, leading to a natural inclination towards rate reduction to ensure a soft landing for the economy. Meanwhile, regional FOMC members directly observe the burdens faced by small businesses and the public from soaring rent and wage costs, driving them to advocate for stringent anti-inflation measures. Thirdly, conflicts regarding the definition of credibility, philosophical disunity. Those led by Powell assert that a central bank's credibility stems from keeping promises and preventing market panic, thereby advocating for preemptive rate cuts. Conversely, Hawks criticize this approach as a repetition of the mistakes made in 2021, when excessive market accommodation led to unchecked inflation, emphasizing that only through aggressive inflation containment can the central bank restore true credibility. This division is no longer merely a quantitative debate. It represents a broader conflict involving economic paradigms, political realities, and central banking philosophy. This guarantees that the tension at the decision-making roundtable will only intensify. The dynamics at this decision-making roundtable have become further complicated by a historic power transition that occurred in May. New chairman Kevin Walsh was formally sworn in on 22nd of May. However, former chairman Jerome Powell did not follow historical precedent by leaving the Fed upon stepping down, but has instead chosen to retain his position as governor until 2028. This implies that at the forthcoming meetings, both the current chairman and the former chairman will simultaneously occupy the FOMC roundtable. Such a situation had not been seen in nearly 80 years of American monetary policy history. Powell's continued presence on the board undoubtedly acts as a powerful force defending his past policy legacy, while also providing a check on the new chairman. However, the future direction of interest rates in this divided roundtable remains ambiguous. To gauge whether this balance is genuinely realistic, an analysis of 6 June's non-farm payroll report is necessary. Currently, let us examine the non-farm payroll report from the 5th of June, which has generated considerable discourse within the market. It is essential to acknowledge that this is an unequivocal and robust report, with May's non-farm payrolls increasing by 172,000, significantly surpassing market expectations of 80,000. Moreover, the historical data for the preceding 2 months has undergone substantial revisions, with March revised upward to 214,000 and April to 179,000, cumulatively adding 93,000 jobs. The impressive performance over these 3 consecutive months, along with the upward revisions, conveys a distinctly positive signal. The employment market in the United States remains resilient, alleviating concerns regarding a potential hard landing or a surge in unemployment in the near term. However, the true policy implications of this data must be interpreted through the lens of the Federal Reserve's dual mandate. The principal value of this strong employment report lies in its capability to alleviate concerns regarding the labor side of the economy for the Federal Reserve. Given the ongoing strength in the labor market, officials can confidently tilt their focus back towards combating inflation. There is no immediate need to hastily lower interest rates in order to prevent a recession. Rather, maintaining elevated rates to wait for inflation to ease remains viable. Upon deeper analysis, while the headline numbers appear impressive, the underlying private sector growth is operating in a measured and constrained manner, lacking signs of rampant overheating. To comprehend this non-farm payroll report, it is necessary to identify the sectors supporting the addition of 172,000 jobs. The foremost contributor is the leisure and hospitality sector, which saw a substantial increase of 70,000 jobs in a single month. This figure significantly exceeds the average monthly increase of 14,000 over the past year. Such notable growth can be attributed not only to the early onset of the seasonal summer travel peak, but also to a critical catalyst, the 2026 World Cup, set to commence in June. As one of the most influential sporting events globally, major host cities in the United States, such as New York, Los Angeles, Miami, and Dallas, were compelled months in advance to implement intensive recruitment and training to accommodate millions of global fans. This World Cup event, driven by international sporting event, is likely more indicative of short-term expansion rather than a signal of widespread economic overheating. The second major pillar is the local government sector, which added 55,000 jobs, primarily concentrated in non-education administrative roles. This area is critical as government hiring does not reflect market behaviors or business confidence regarding future demand, but rather expenditure of fiscal budgets. When summing these two contributions, the reality of the reports unfolds. Together, leisure, hospitality, and local government contributed 125,000 jobs. Excluding these two sectors, the remainder of the vast economy only added 47,000 jobs. In a truly buoyant labor market, growth would ideally be widespread, yet this report is supported by two structurally incongruous sources of growth. The third sector, healthcare, experienced a steady increase of 35,000 jobs, roughly in line with historical averages. The stability of healthcare employment is attributed to the rigid demand stemming from an aging population, irrespective of the economic climate. Individuals will continue to seek medical attention when unwell. This stability does not signal economic vigor. Instead, it serves as a warning that when the cyclical engines eventually shall stall, only defensive sectors will be left to sustain the market. The fourth sector, which raises significant concern, is finance, which saw a reduction of 22,000 jobs in May. This is not a one-off anomaly, since reaching a recent peak in May of the previous year. The finance sector has cumulatively shed 107,000 positions over the year. The finance sector is acutely sensitive to interest rates, and its ongoing contradiction is indicative of the early impacts of high rates beginning to undermine the real economy. By piecing together these four components, the actual state of the non-farm payroll report becomes clear. The headline figure of 170,000 is genuine, yet its quality is considerably inferior to its quantity. It is unsustainably propped up by surging hospitality employment, governing hiring irrespective of economic conditions, and rigid healthcare, while truly cyclical sector, reflecting the heat of the private engine, remain far from overheating. To fully grasp this employment report, it is vital to recognize its composition of two independent surveys. Employer survey. This inquires companies about how many payrolls were added this month, arriving at the headline figure of at 172,000. Household survey. This directly consults the general populace by asking, are you currently employed and is your job search proceeding smoothly, leading to an unemployment rate of 4.3%. When shifting focus from the notably 172,000 new jobs to the nuanced details of the household survey, a cooling job market environment is revealed. Static labor participation rate subduing unemployment rate. The ability of the unemployment rate to maintain a low level of 4.3% is partly attributable to the labor participation rate stagnating at a low 61.8%. According to economic definitions, only those who are actively seeking work but cannot find it are classified as unemployed. If individuals temporarily increase their search due to difficulties or choose to return to family or educational commitments, they are not included in the unemployment figures. The stagnation of the labor participation rate implies that a segment of potential job seekers has exited the market, effectively lowering the unemployment rate, rendering it more favorable than reality. Increasing numbers of involuntary part-time workers indicating full-time job deficits. Data indicates that the number of individuals compelled to take part-time or gig work due to economic factors, such as companies reducing hours or inability to find full-time positions, is quietly rising. This suggests that although these individuals are nominally classified as employed, hence not counted in the unemployment rate, they do not receive stable full-time income, only inconsistent part-time earnings. This reflects that while companies continue to offer job opportunities, high-paying, stable full-time positions are beginning to contract. The state of low hiring, low layoffs. This also elucidates why the overall labor market appears stable. It is currently in a delicate balance, characterized by a low hiring, low layoff scenario. Low layoffs means companies having experienced significant labor shortages in recent years are acutely aware of the costs associated with re-recruiting and retraining staff. Consequently, even amid a slowdown in business due to high rates, companies are reluctant to resort to layoffs. However, low hiring means simultaneously, in response to future economic uncertainties, companies have halted aggressive expansion and recruitment plans. This has led to a substantial reduction in labor market fluidity, with current employees hesitant to move and companies disinclined to hire. The surge in long-term unemployment, difficulty resuming employment after job loss, represents the core concern of this report. Data indicates a 524,000 increase in individuals unemployed for over 27 weeks compared to the previous year, raising the share among all unemployed individuals to 27.5%. This indicates that the margin for error in the employment market has significantly diminished. As long as one possesses a job, maintaining the status quo becomes feasible. However, should one lose their job for any reason, they may find themselves effectively locked out. Given that companies have ceased expansion, the number of new jobs openings is minimal, necessitating much longer, often surpassing 6 months to find new employment. In summary, the current labor market exhibits a nuanced condition characterized by strong headline figures, yet internal momentum is actually slowing, as the employment side remains in its just right Goldilocks state. The Federal Reserve finds itself with fewer concerns. This implies that future policy directions will not be predominantly influenced by employment data. Officials can and must focus entirely on inflation data. In May, the annual Consumer Price Index inflation increased to 4.2%, marking the highest level since 2023, driven by rising energy prices. The initial step in analyzing inflation involves distinguishing between core and non-core indicators. Non-core inflation encompasses food and energy, which are excluded due to their inherent volatility. Energy prices are particularly susceptible to fluctuations caused by cold weather, geopolitical conflicts, or pipeline incidents, resulting in significant short-term volatility. These supply-side driven variances often obscure the underlying persistent signals that reflect the intrinsic heat of the economy. Consequently, the Federal Reserve observes core inflation by removing food and energy, enabling policymakers to disentangle short-term noise and scrutinize the underlying momentum of price increases. Core inflation represents the aspect of monetary policy that can be effectively regulated, as interest rate hikes cannot mitigate geopolitical tensions, but can successfully temper overheating demand. However, the foundational assumption behind excluding energy is that its price fluctuations represent exogenous noise that does not exert a structural influence on core prices. This assumption holds generally but currently fails, as the factors pushing all prices upward are not typical seasonal elements but stark geopolitical conflicts. The disruption in the Strait of Hormuz has disturbed global supply chains, causing various prices from gasoline to airfares to rise comprehensively. Data reveals that energy costs surged annually by 23.5% in May, significantly higher than April's 17.9%, with gasoline prices experiencing an impressive annual increase of 40.5%. This geopolitical-driven energy pressure is unlikely to recede in the short term. Recently, market participants have feared that this energy pressure could infiltrate core inflation through indirect pathways. Increased diesel costs raise food transportation expenses, while rising oil prices elevate airfare, gradually transmitting inflation into the core metric. Recent data has evidenced this potential infiltration. Nevertheless, the most crucial and reassuring signal emerging from the May CPI report is that this backdoor remains secure. The most concerning transmission channel, transport services, experienced a decrease of 0.6% in May, illustrating that elevated energy costs did not spill over into other sectors. Similarly, the increase in service categories, excluding energy, slowed to 0.3%, down from April's 0.5%, suggesting a deceleration rather than an acceleration in the underlying momentum of core services. Even concerns regarding tariffs appear to be receding. Core commodity prices decreased by 0.1% in May, indicating that the pressure from tariffs has remained relatively mild. Moreover, it is important to note that airfare prices did rise by 2.7%, serving as a clear sign of high energy cost transmission. In conclusion, while energy prices were indeed more intense in May than in the previous month, they remain primarily outside the core inflation threshold, leaving only a trace of impact on airfare. Examining recent inflationary trends, the key aspect of the latest May CPI report is the bifurcation of the previously upward-sloping trend into two diverging paths. Beginning with a more moderate onset in February, the headline CPI annual growth rate briefly fell to a low of 2.5%. In March, the curved shape sharply reversed, and the annual CPI growth rate rebounded to 3.3%. April marked a continuation of this upward movement, with a rise in the overall CPI annual growth rate to 3.8%. In May, influenced by rising energy costs, the headline inflation trend steepened further, with the overall annual inflation rate escalating to 4.2%, the highest since April 2023. This marks the third consecutive month of accelerating in headline inflation, with a seasonally adjusted monthly price increase of 0.5%. Analyzing this figure could easily lead the market to panic over a scenario in which inflation appears to be entirely out of control. However, it is essential to note the contrasting direction of core CPI, which experienced only a 0.2% monthly increase, resulting in an annual growth rate of 2.9%, falling short of market expectation of 0.3% and below the April figure of 0.4%. Other contributing indicators point towards cooling inflation. Housing, which plays a significant role in the Federal Reserve's consideration, rose merely by 0.3% in May, a reduction in growth rate resulting in an annual increase of 3.4%, while food prices saw only a marginal increase of 0.2%. The simultaneous deceleration in housing and service sectors, both sticky indicators of demand overheating, represents compelling evidence of a flattening core inflation curve. While CPI is a focal point for public attention, the measure most prioritized by the Federal Reserve is the Personal Consumption Expenditures (PCE) price index. Recent data indicates that core PCE rose by 0.3% month-over-month, propelling the annual inflation rate to 3.3%, still considerably exceeding the official target of 2%. At the same time, the newly appointed Federal Reserve Chair, Kevin Walsh, has introduced an intriguing variable in monetary policy perspectives: his preference for the truncated mean PCE. What is truncated mean PCE, and how does it differ from the conventional core PCE? Traditional core PCE applies a simplistic approach by essentially excluding food and energy from consideration. However, this method is inherently flawed for two reasons. First, it assumes that food and energy are mere noise, disregarding their potential to permeate other sectors. Second, it retains all other categories, including those exhibiting extreme price fluctuations. For instance, a temporary surge in used cars prices, which may unfairly influence core data. The methodology of the truncated mean PCE entails recording all price changes among the goods and services in a PCE basket, from lowest to highest each month. This approach disregards category labels and directly excludes the most extreme fluctuations on both ends, such as removing the highest 24% and lowest 31% of price movements. Ultimately, a weighted average is calculated from the remaining approximately 45% of products that demonstrate the most stable and moderate trends. The differences between the two approaches are significant. Traditional core PCE is susceptible to distortions from outlier effects, such as the 20.7% spike in airfare in April due to rising oil prices, impacting the overall reading and potentially misleading the market into believing inflation is entirely out of control. Conversely, the truncated mean PCE effectively categorizes such extreme monthly price surges as noise and concentrates on the moderate and steadily rising underlying categories. It measures the most accurate and stable price base throughout the economy. Currently, the truncated mean PCE annual growth rate reported by the Dallas Federal Reserve hovers around a moderate 2.3%, which is significantly below the 3.3% of traditional core PCE. The divergence between these indicators adds tension to the internal dialogue within the Federal Reserve's decision-making framework. On one hand, Walsh's preferred truncated measure suggests that if extreme fluctuations caused by geopolitical conflicts are excluded, the structural inflation pressures within the US economy are relatively mild and close to the 2% target. On the other hand, the rebound in traditional core PCE remains a concern for other committee members. For central banks, while current high inflation poses a challenge, the most perilous scenario is when public expectations regarding future inflation become dislodged. If consumers and businesses anticipate ongoing price increases, such expectations could translate into heightened wage demands and increased frequency of price adjustments, potentially triggering a self-fulfilling inflation spiral. Previously, university surveys indicated a spike in one and long-term inflation expectations due to energy price fluctuations, which raised market concern. However, the latest published data demonstrates that inflation expectations are not as robust as previously feared. According to the most recent consumer expectation survey by the New York Federal Reserve, individuals' one-year inflation expectations decreased slightly from 3.6% to 3.5% in May, with the 3 and 5 medium-term expectations stabilizing at 3.1% and 3.0% respectively. This indicates that while residents continue to sense price pressures in the short term, long-term inflation expectations remain firmly anchored within historical reasonable ranges. Simultaneously, market indicators such as the 10-year break-even inflation rate have consistently remained stable. This supports the assertion that current inflationary pressures do not resemble the systematic disconnection experienced in the 1970s. Taking into account all aforementioned clues, my assessment is that although inflationary conditions have inherent risks, they are not yet out of control. The danger lies in energy pressures originating from geopolitical conflicts, which are permitting core inflation through food and transportation services. While supercore inflation continues to show wage steadiness, these factors dictate that the Federal Reserve must remain vigilant and maintain sufficient defensive posture in its policy statements. Nonetheless, the evidence suggesting inflation is not out of control is equally robust. Tariff impacts have diminished, commodity price trends are moderate, and most importantly, inflation expectations remain stable, with no signs of disconnection. Furthermore, ShareWatch preferred truncated MPC indicator suggests that the underlying structural inflation pressures are indeed more subdued than what surface level data may indicate. This places the Federal Reserve in a highly delicate policy position. Thus, I believe that the most likely policy scenario will involve retaining the current restrictive high interest rates and periodically conveying hawkish sentiments. The Federal Reserve needs to utilize continuous verbal intervention to temper market expectation of interest rate reductions, thereby maintaining a constricted financial environment. Under this strategy, the Federal Reserve does not need to orchestrate a systematic interest rate hike cycle dramatically. Even with future inflation data tends to exceed expectations due to short-term shocks, compelling the Federal Reserve to respond, such action is likely to be a single increase. This insurance hike serves to convey the central bank's commitment to upholding inflation targets and to firmly anchor inflation expectations, rather than signaling the initiation of a new restrictive storm. This approach characterized by gaining time at the expense of space, substituting verbal hawkishness for tangible actions, and only hiking when absolutely necessary, serves both to avert inflation expectations from loosening due to short-term disturbances and to minimize unnecessary harm to an already cooling real economy. However, this seemingly rational strategy is subject to significant variable, the result of a decision maker. We can overlook that the Federal Reserve is currently under the leadership of a new chair with a markedly different operation style. How will Kevin Walsh, the new appointee, think and strategize? On 13th of May, Kevin Walsh was confirmed as the 7th chairman of the Federal Reserve with a narrow vote of 54 to 45. This instance marked one of the most contentious and precarious decisions in the Federal Reserve history. Elevated to this prestigious role with a historical narrow margin, Walsh confronted a divided Federal Reserve from its first day in office. Alongside presidential pressures and rampant inflation, every action he undertook would be subject to intense scrutiny and questioning. This combat situation served as a catalyst for Walsh's deployment of a novel rhetorical framework, necessitating tools that communicated to external audiences his commitment to combating inflation while avoiding overt contradictions with political pressure for interest rate reductions. The crucial mechanism for this was the balance sheet. To comprehend Walsh's novel strategy, it is imperative to take a step back and dissect the two fundamental instruments at the Federal Reserve's disposal: interest rates and the balance sheet. And for those who have never heard of interest rate or balance sheet, I recommend you, if you understand Cantonese or you can withstand the YouTube automatic dub, you may watch my old videos. I have introduced the business cycle and the interest rate, basic knowledge, some essential beginner's knowledge in our Cantonese channel. 毒撚賺錢台 our major channel, which is Weebearn HK VTuber. And let me share our link also. And in a rich mindset or financial quotient education series, you may review some most basic concepts for you to make money. The historical transition from unilateral actions to dual approaches, we have to talk about the quantitative easing QE and the labor of change LLC. Prior to the financial crisis of 2008, the Federal Reserve primarily engaged in actions with a singular focus: interest rates, specifically the short-term policy rate. The operational logic was classical in nature. The Federal Reserve would set a federal funds rate target and adjust the purchase and sale of short-term government securities in the open market to regulate the level of reserves within the banking system, which was characterized by a scarcity regime for reserves. This process resembled the meticulous manipulation of a valve, regulating the temperature of the overnight lending market, intra-bank lending market, thereby influencing the short-term borrowing costs across society. At that time, the Federal Reserve's balance sheet measured around $900 billion, merely a byproduct of interest rate policy rather than an independent tool for action. However, the financial crisis of 2008 irrevocably altered the historical trajectory. The Federal Reserve's response involved slashing short-term interest rates down to zero lower bound. Despite this, the economy exhibited little signs of improvement, as the effectiveness of interest rate diminished due to their limitations. The Federal Reserve relied on a secondary tool, the balance sheet quantitative easing (QE). By shifting to the balance sheet mechanism, akin to turning on a fire hose, the Federal Reserve began injecting capital into the economy through aggressive purchases of long-term government bonds and mortgage-backed securities (MBS). This marked the advent of a dual approach era. Since 2008, the Federal Reserve has primarily employed two contrasting maneuvers to regulate the economy. The operation and effects of balance sheet expansion are known as QE. When the Federal Reserve aims to stimulate the economy, it effectively created reserves, purchasing large quantities of long-term bonds from financial institutions. This action prompts a portfolio rebalancing effect. As the Federal Reserve exhausts available safe government bonds, private investors, now flush with cash, are compelled to seek higher-yielding assets such as corporate bonds, stocks, and real estate, thereby inflating asset prices and fostering a wealth effect that encourages consumption over the whole asset domain. Additionally, the robust purchasing activities of the Federal Reserve raise bond prices, which in turn compresses long-term bond yields, such as those of 10-year government bonds, and directly minimizes long-term borrowing costs for businesses and individuals. Contrarily, the operation and effects of balance sheet reduction, known as QT, when inflation reaches excessive levels and necessity cooling, the Federal Reserve activates a reduction in its balance sheet. The common procedure during this phase involves a do not reinvest upon maturity approach, as bonds mature and the Treasury repays principal. The Federal Reserve refrains from purchasing new bonds, facilitating a natural contraction of its balance sheet. This action serves to withdraw funds from the financial system, effectively reducing liquidity while compelling the Treasury to issue new bonds to private investors. An increase in bond supply results in higher long-term interest rates, exerting a suppressive effect on higher-risk assets like stocks. And to explain reasons for the public and market's frequent focus on interest rates over balance sheet adjustment, a prevalent observation in daily media reporting reflects that discussion often emphasize rate hikes or rate cuts, while neglecting mainstream conversations regarding the historical balance sheet reductions or expansions. This phenomenon can be attributed to three cognitive biases. The first of all is the intuitive communication. Interest rate represents a singular, clear, numeric figure, for instance 5.25% or the current 3.5%. Individuals experience immediate repercussions from interest rate changes through home purchases, credit card usage, and saving accounts. Conversely, the balance sheet portrays an abstract multi-trillion-dollar figure whose transmission mechanisms are often too opaque for the general public and even stand investors to grasp. The second reason is the inertia of history. The academic and market discourse on interest rate policy enjoys over a century's worth of research, yielding mature models and forecasting tools like the Phillips curve we've mentioned above. And in contrast, the use of the balance sheet as a policy instrument has emerged only in recent decades, with discussions still exploring its specific implications. Thirdly, there is a deliberate diminution by the Federal Reserve. Federal Reserve officials, including former Chair Yellen, have described the process of balance sheet reduction as a monotonous, passive observation, akin to watching paint dry. The Federal Reserve's conscious avoidance of elevating the balance sheet as a regulatory tool aims to prevent unnecessary market panic. In summary, the adjustment of interest rate resembles the fine-tuning of a process flow rate, whereas manipulating the balance sheet in historical context entails direct alterations to the reservoir's total water supply. So, to understand Walsh's approach or his philosophy, one must visualize the current state of the Federal Reserve's balance sheet, totaling approximating $6.7 trillion, a remarkable increase from around $900 billion prior to the 2008 financial crisis and peaking near $9 trillion in 2022. This transition from $900 billion to $9 trillion represents a tenfold expansion. Even with some reduction from the peak, the existing level of $6.7 trillion is still over 7 times greater than pre-crisis amounts. This substantial increase is precisely why Walsh has expressed concern. His position is unequivocal. He advocates for balance sheet reduction, contending that this current size results in an excessive presence of the Federal Reserve in the financial markets, explicitly characterizing it as bloated. Walsh is adverse to the Federal Reserve injecting support in the markets as it has historically done, strongly arguing for the use of interest rates rather than the balance sheet for routine economic regulation. Walsh contends that an overly large balance sheet positions the Federal Reserve as an omnipresent entity in the markets, perpetually offering support. He envisions a scenario in which the Federal Reserve steps back, reallocating market dynamics back to the realm of the market itself. Conventional wisdom equates tightening with the raising of interest rate, adjusting the short-term policy rate. However, in Walsh's policy framework, he is more inclined to utilize another tool, reducing the balance sheet, which is to modulate the long-term interest rates. This introduces a potentially unprecedented scenario. The Federal Reserve could lower the publicized short-term rates while concurrently elevating long-term interest rate through balance sheet contraction. Superficially, this appears dovish, yet fundamentally it is hawkish. As headlines proclaim the Federal Reserve is lowering rates, the market may initially respond positively. However, the long-term rates, which dictate consumer borrowing costs and mortgage rates, could be surreptitiously pushed higher due to the balance sheet contractions. The genuine challenge to asset pricing services as the primary determinants of stock market's valuation, particularly for technology and growth stocks, hinge on long-term discount rates. While a reduction in short-term rates might offer little benefit, an increase in long-term rates resulting from a contracting balance sheet could directly destabilize the foundation of overvalued state assets. Why does balance sheet contraction elevate long-term rates? The underlying principle is merely one of supply and demand. As simple as that, and the Federal Reserve reduces its balance sheet, opting not to reinvest. It effectively withdraws from the bond market. compelling the Treasury to issue more new debt to private investors. As more bonds flood the market while the foremost buyer, the Federal Reserve, recedes from the scene, the excess supply leads to declining bond prices and consequently rising long-term bond yields. Additionally, as private investors bear increased risk associated with long-term holdings, they will seek higher interest returns, term premiums. Consequently, the crux of grasping Walsh's perspective lies in diversifying one's assessment beyond merely whether rates are increasing to consider which tool the Federal Reserve is actively deploying. This mindset profoundly impacts market psychology, directly challenging the prevailing belief in the Federal Reserve put that has endured over the past 2 decades. Historically, investors have operated under the conviction that in cases of severe market downturns, the Federal Reserve would invariably interfere with rate cuts to stabilize the economy. This belief has illustrated the Federal Reserve as providing a free safety net that empowers investors to buy the dip. However, Walsh's preference for balance sheet reduction aims to shift this safety net downward. Such a change does not imply that the Federal Reserve will refrain from action during market downturns. The safety net remains intact. Rather, the threshold for intervention has risen. Previously, a 10% decline in the stock market may have prompted immediate action from the Federal Reserve. However, under Walsh's logic, the market would need to experience greater declines with more palpable pain for the Federal Reserve to consider intervention, thus reflecting a systematic crisis. This represents a significant psychological shift within the institutional framework, known as a regime change. Once investors perceive that the safety net is further away, they must incorporate a greater margin of safety in their decision-making, thereby suppressing market risk appetites more profoundly than any singular interest rate hike. Now occupying the position of the 17th chairman, it is crucial to recognize the uncertainty surrounding Walsh's prospective actions. Within financial markets, the most precarious premise is embracing the pronouncements of officials as singular truths. Publicly, Walsh is characterized as a proponent advocating for a balanced reduction in the balance sheet, insisting that rates should be utilized rather than the balance sheet to regulate the economy. However, in closed-door discussions, Walsh may have made certain compromises with Trump, who advocates for lower rates for economic stimulation. While Walsh promotes balance sheet reduction aimed at curtailing asset bubbles, the specifics of any alignment reached in private discussion remain an obscure entity. Nevertheless, the salient point is that he cannot and will not act independently. The first impediment arises from the constraints of political and institutional consensus, the divided farm C. This hurdle is compounded by his own commitment. He made it clear during testimonies that balance sheet reduction cannot proceed hastily, and any alterations in balance sheet policy necessitate a consensus within the FOMC. Moreover, the current FOMC exhibits significant internal discord, with diverse perspectives at play. Even former Chair Powell's ongoing presence within the board serves as a counterbalancing force of considerable importance. In this context, even with Walsh seeks to deploy balance sheet reduction in lieu of rate hikes, convincing all members and establishing consensus within a short time frame will prove exceedingly challenging. For a newly appointed chairman possessing historical legitimacy deficits, implementing aggressive balance sheet reductions during his inaugural year represents an almost inconceivable political undertaking. The second barrier concerns the physical limits of market mechanics. The turmoil within the repurchase markets experienced in 2019 serves as a notable cautionary instance for the Federal Reserve. When reserves were drawn too low, the overnight lending rate surged precipitously, necessitating an urgent reversal from the Federal Reserve. This situation underscores that excessive balance sheet contraction could lead to fundamental ruptures in market systems. When these two barrels are synthesized, while Walsh possesses the will to act, he is devoid of the authority to act alone, and his capacity for rapid implementation is severely constrained. When one extrapolates Walsh's worldview, it becomes evident that three trajectories converge towards a singular direction. First, he is not in a rush to adjust short-term rates. The market tends to interpret him as hawkish, yet he does not belong to the traditional hawkish camp that adheres to the Phillips curve, eager to raise rates in response to strong employment metrics. Instead, he holds a belief in a larger bet, convinced that artificial intelligence serves as a structural deflationary force, analogous to the productivity boom of the 1990s, that ultimately cools inflation organically. Consequently, his interest in raising short-term rates appears minimal. Possessing confidence in eventual structural disinflation negates the rationale for engaging in a relentless rate hike cycle witnessed in 2022. Second, his primary focus lies with the long-term rates. He perceives the balance sheet as bloated, and he desired tightening centers on balance sheet contraction, redirecting pressure onto the long end of the curve. This preference will persist regardless of constraints imposed by the FOMC. It may merely be compelled to decelerate, yet the directional aim remains clear, with pressures continuing to accumulate on the long end. Third, he is inclined to shift the safety net downward, diminishing the Federal Reserve put and returning market dynamics to the market itself, a change that does not necessitate any formal votes. It involves merely adopting a stance of not rushing to interfere. This elucidates why I previously concluded that the hawkish stances will be maintained from our macroeconomic analysis, with any rate hike occurring solely under pressing necessity. Walsh is scheduled to preside over his first FOMC meeting, post-ascension on 16th to 17th of June. This meeting will not only update economic forecast (SEP), but will also serve as the first opportunity for the market to observe his approach to communication dynamics and policy articulation within the intricacies of the dual mandate, power remaining with a dual carriage with power remaining on the board, and a highly fragmented committee. This is like in Chinese history. Within a same dynasty, there are two emperors. No, just kidding. The statements and press conference following this week. This meeting may provide early indicators of his policy styles throughout his tenure. To discern the trajectory of the current scenario's conclusion, we must produce historical records to uncover the events experienced by the market when the Federal Reserve previously pursued single-event defensive rate hikes over the last previous 3 decades. So who comprises the Federal Reserve Board? Upon the Federal Reserve's definitive decision to tighten monetary policy, what has historically transpired? Furthermore, how might the habitual tendencies of history be altered by the contemporary realities previously deduced? Over the past 3 decades, the rate hikes implemented by the Federal Reserve have generally followed a cyclical pattern. The periods of 1994 to 1995, 1999 to 2000, 2004 to 2006, and recent instances from 2015 to 2018 and 2022 to 2023 exemplify this trend. In these classic cycles, once the Federal Reserve initiates a rate increase, it is akin to embarking on an ever-moving escalator, proceeding incrementally until economic activity is roughly stifled or inflation completely subdued. This habitual pattern instills a profound collective anxiety within the markets. The mere commencement of remarks from the Federal Reserve signifies the onset of a new wave of repercussions. However, when integrating the realities delineated in previous sections, such as the White House intense aversion to high interest rates and a highly divided and checks and balance abroad, it prompts an audacious inquiry. Can the Federal Reserve generally replicate its past operational patterns of pronounced cyclical rate increases in the current climate? In fact, within a unique context characterized by sticky yet non-explosive inflation and a robust but cooling economy, there exists potential for the Federal Reserve to be compelled to transition toward a more infrequent yet flexible defensive mode of operation. The predominant strategy they might employ is hawkish hope, when they refrain from immediate action while utilizing stern rhetoric to intimidate the market, thus preventing premature loosening of financial conditions. Even when action becomes necessary, their inclination would lean for minimal defensive adjustment, followed by prolonged periods of observations. A thorough examination of three pivotal narratives from the past 3 decades elucidates the authentic trajectory of this policy behavior and the corresponding market responses across frame phases. Rewinding to early 1997 depicts a peak era for the US economy, as the internet boom sparked and unemployment rates plummeted and stock market surged. The then Federal Reserve Chairman, Alan Greenspan, faced not an immediate crisis, but rather a more nuanced preventative issue. Would inflation stealthily revive amidst such economic prosperity? Greenspan had signaled early on. His renowned Irrational Exuberance speech in December 1996 had already alerted the markets to the possibility of impending Federal Reserve action. By March 1997, the Federal Reserve announced a rate hike of 1/4%, increasing the benchmark interest rate to 5.5%. This was regarded at the time as a prophylactic measure against the resurgence of inflation. The market's reaction warrants scrutiny. Prior to the rate hike, due to Greenspan's well-signaled intentions, market expectations were quite high, leading to relatively limited fluctuations in both bond and stock markets. On the day of the announcement, there was a modest decline in the stock market, which was quickly regained. The more compelling aspect lies in the Federal Reserve's subsequent 18-month period of inaction. Following this one-time insurance adjustment, rates remained fixed at 5.5% for a full 18 months. What transpired thereafter surpassed all anticipations. The Asian financial crisis erupted in the summer of 1997, subsequently escalating into a global crisis in 1998, followed by Russia's debt default and the near collapse of the hedge fund LTCM. The Federal Reserve's next maneuver shifted from continuing rate increases to reversing course to cut rates in an effort to rescue the market. This serves as a rare yet archetypal instance of a one-time insurance hike. The central principle here is not the entrainment upon an endlessly moving escalator, but rather a singular preventative action, allowing time and data to dictate future maneuvers. Markets had prepared prior to the hike, and no panic selling ensued post-hike. True narrative shifts were instigated by external shocks. Furthermore, the insurance adjustment in 1997 has an intriguing dimension, resonating significantly with contemporary circumstances. Greenspan's confidence in executing a one-time adjustment before relinquishing control to time stemmed not only from moderate inflation, but also from an underlying belief that the nascent investments in computers and the internet were gradually transforming the productivity landscape of the economy. He consistently expressed in FOMC meetings and public addresses his suspicion that official productivity data underestimated the genuine growth propelled by IT. To reframe this, he was wagering that the productivity boom from technology would enable the economy to flourish without spiraling inflation. History would validate his gamble. During the latter part of the 1990s, the US economy experienced a golden combination of high growth, low inflation, and low employment. This narrative not only encapsulates the events of 1997, but also serves as a historical prototype for the dynamics portrayed in the preceding chapter regarding Walsh. The second narrative unfolded during the protracted recovery following the financial crisis, in which the Federal Reserve maintained interest rates near the zero lower bound for 7 years. By the end of 2015, with the labor market becoming increasingly robust, the Federal Reserve resolved to initiate monetary policy normalization. In December 2015, the committee announced a 1/4% rate hike, marking the first increase in nearly a decade, term lived off by the markets. This rate increase had been a well-anticipated precursor in the market. Following the 2013 taper tantrum, the Federal Reserve had consistently communicated through forward guidance that normalization would ultimately occur. By the end of 2015, the market had fully priced in this increase, resulting in relatively stable pre-announcement fluctuations. On the announced day, the stock market experienced an expected decline slightly, but did not trigger a panic cascade. The subsequent developments, however, are what demand attention. Both market participants and the Federal Reserve officials had anticipated additional rate hikes 3 to 4 times in 2016. However, with a precipitous drop in global oil prices, rising concerns over the Chinese economy, and a significantly strengthening dollar, the Federal Reserve swiftly adopted an exceedingly cautious stance. They only managed to raise once more in December of 2016. There was a full year between the first and second hikes. This illustrates that even when the Federal Reserve verbally advocates for an interest rate cycle, actual implementations can be excruciatingly slow, and it may vary during the process. Initiation does not equate to continuity. In a scenario where the economy is moderate but external risks intensify, the Federal Reserve may proceed at a staggering slow pace. The true deviation in market dynamics post-hike was driven by oil prices and global risk events, rather than an ongoing escalation from the Federal Reserve itself. If the preceding narratives exemplify the Federal Reserve's restraint, then 2022 represents the moment the Federal Reserve completely shed its moderate facade. The impetus for this adjustment arose from a serious misjudgment regarding the nature of inflation. When prices began surging in 2021, the Federal Reserve remained convinced that it was merely a transitory phenomenon born from supply chain disruptions, thus keeping its foot on the accelerator for an extended period. Upon realizing that inflation has spiraled out of control, the Consumer Price Index surged once to a 4-decade high of 9.1%. In response to this untenable scenario, the Federal Reserve adopted a textbook approach of aggressive countermeasures. Following a tentative rate hike in March 2022, the Federal Reserve then proceeded to administer a sequence of 4 consecutive hikes, each amounting to 0.75%. This fervent response extended until July 2023, during which the benchmark interest rate surged by 525 basis points within a mere 18-month span, again 1.5 years. The defining trigger for this onslaught was the alarming surge beyond 9%, accompanied by imminent threats of a self-perpetuating inflationary spiral. Only under such extreme duress would the Federal Reserve forsake all decorum and institutional constraints, opting instead for the most radical measures to restore credibility. When contrasting these 3 historical accounts with our current circumstances, we may arrive at early stage of conclusion. The determining factor for whether the Federal Reserve opts for a hawkish hold with potentially one defensive adjustment or repeated onslaught fundamentally resides on the nature of inflation. Our present economic landscape is characterized by inflation coiling around 3%, persistent yet not sparing uncontrollably. Concurrently, although the labor market appears superficially heated, it is in fact not heated at all. This economic temperature aligns with the scenarios of 1997 and 2015, wholly distinct from the feverish inflationary conditions of 2022. In the cases of both 1997 and 2015, the Federal Reserve provided ample preemptive signals to the market, allowing for significant preparation prior to the rate hikes. The initial reactions post-hike remain relatively manageable. Crucially, it is often external shocks, rather than continued aggressive measures from the Federal Reserve, which reshuffle the narrative trajectory moving forward. This indicates that in non-extreme environments, the Federal Reserve possesses the capability of one-time or exceedingly gradual adjustments, without necessarily embarking upon a path of continuous tightening. Thus, the market's primary apprehension regarding a repeat of the chain tightening tempest reminiscent of 2022, in my view, remains non-narrative. However, an essential distinction must be made. During 1997, Greenspan wielded only the tool of short-term interest rates, whereas this time, Walsh's genuine intention is to influence the long end. Thus, while the historical shape resonates, one-time defensive followed by prolonged observation, the locus of intervention has shifted. The pressures that once bore down on short-term borrowing costs in 1997 are now being accumulated at a crucial factor determining stock market valuation, the long-term discount rate. At this juncture, the macroeconomic fog has largely dissipated. However, for investors navigating the market, the real test is just beginning, as capital ultimately grasps that the era of low rates is not swiftly returning. Strategic adjustments must be contemplated. When the market has significantly risen, any reason will be utilized as an excuse for correction. This could stem from unexpected inflation data, a statement by a newly appointed Federal Reserve official Walsh, a geopolitical conflict, or merely a decision by a major fund to take profits on a Tuesday morning or Wednesday morning. Excuses will emerge like the big news may emerge spontaneously. Yet what we should genuinely focus and concern ourselves with is the quantity and location of the energy power source and whether it might be lethal. In the prior 2 months, technology stocks, particularly those associated with semiconductors and AI, have experienced a remarkably frenetic surge, which we are going to talk about. While the market reveals in its fees, valuations have escalated to rather strange levels. At this juncture, the market urgently requires reason for profit-taking and consolidating position. Last Friday's unexpectedly strong non-farm report, last Friday's untempered, Friday on the 5th of June, strong non-farm report conveniently provided the market with an excellent excuse or a big news. And also, we observed there is a shift in macroeconomic narrative from AI frenzy back to macroeconomic race. Different periods are characterized by distinct market narratives. Over the previous 2 months, the optimistic outlook for AI dominated the scene, causing the market to overlook the tightening macroeconomic environment. However, even if we infer that the Federal Reserve's baseline prediction remains hawkish or at most one more defensive rate hike, this signifies that rates will remain at elevated levels for an extended duration. The uncertainty surrounding this interest rate trajectory is compelling the market's narrative focus to shift away from the simplistic AI frenzy back to macro rates. In the forthcoming FOMC meeting, we're looking forward to the performance by Walsh, as it will be challenging for Walsh and the committee to provide an absolutely clear and precise guidance that alleviates all concerns. This suggests that the market will find it difficult to sustain the unabashed frenzy observed in recent time. With a changed narrative and heightened valuation, the market will be more inclined to pause, awaiting substantive profit alignment with valuations. We can continue to believe in the long-term structural opportunities brought by AI, yet the time for aggressive investment is not at hand. In this environment, the most prudent approach is to maintain flexibility and focus on asset quality, focus on the fundamentals, the quality of individual stocks and company, rather than attempting to precisely focus every action taken by the Federal Reserve. To comprehend the forthcoming capital allocation logic, we must also clarify the nature of this adjustment. The subtle differences in technology stocks. The pain point resides not in the numerator, but in the denominator. So the valuation of a stock can be loosely conceptualized as future cash flows. As you may know, the infinite sum of discounted cash flows, which is the numerator. Discount rate is the denominator, in which, however, historically, market concerns primarily centered on the numerator, which is the future cash flows, before discount, namely whether companies are profitable and if earnings per share (EPS) will decline. However, in a scenario where high rates persist for an extended period, the genuine threat originates from the denominator, or the coefficient of the GS, of the geometric sequence, which is the discount rate, the long-term interest rate. Assets that concentrate cash flows primarily in the distant future, like the high-growth stocks with extended duration, and especially the SpaceX that we are going to talk about in the next session, will see their valuation compress as the discount rate increases and uncertainty heightens. Just like in reinforcement learning, when you set the alpha decay hyperparameter high, the agent or the AI will not learn the more long-term rewards, and they may only focus on some short-term like the financial reports, like the 踏實財務報表. You'll see the valuations compress as the discount rates increase, and also the uncertainty heightens. So even if their earnings remain intact, the market tends to reduce the premium it is willing to pay for stories that involve a long wait for realization. So here I would like to supplement a statement claimed by another VTuber, another famous local VTuber. Why even stories and narratives that a company may earn like 200 times, 300 times in the coming 20 or 30 years does not constitute that you should buy the stock in this immediate moment. Is because of the interest rate, and the interest rate will diminish the longer terms, like the distant future cash flows at a exponential scale. And so you can when the interest rate is high, according to the DCF model, we have to focus more on the close financial reports. Facing the threat to the denominator, the interest rates, would be overly simplistic to dismiss high growth stocks altogether, thereby missing the most captivating twist of the entire narrative. In truth, AI remains an irreplaceable core in the economy, and we should be asking, how can we continue participating in AI's long-term structural opportunities while avoiding excessive aggression in a higher uncertainty environment? This necessitates a nuanced differentiation among technology stocks. A broad brush approach is inappropriate, and the situation for technology stocks is inherently twofold. One aspect is the threat to the denominator, persistently high rates compressing valuations. And also the other aspect where most people may forget or may not know is that the support from the numerator. Productivity improvements driven by AI which are generally sustaining or even enhancing corporate profitability. Notably, the argument that AI supports profitability, the economic growth numerator aligns closely with Walsh's core belief. Or in the early days, back in the last century, the belief of the early stage Fed chairman Greenspan. So as the rich mindset says, in order to make money or in order to earn money, you have to look in the distant future, and you have to be you have to look at the big picture and be more foresight. Short-sighted people cannot earn much money, and so when interest rates are elevated and the cost of time escalates dramatically, those companies that have already realized significant profit growth in their financial reports will see their numerator profits grow significantly, outpace any valuation compression induced by the interest rates. And let's prioritize maintaining an investment in AI leaders with current substantial profitability and cash flows. This underscores the importance of not treating all AI concepts uniformly, since AI is central and has robust industry trends and policy beliefs supporting it. Responding to the shift in macro narratives hinges on the timing of profit realization, just like timing the market. While Walsh is betting on a long-term profitability narrative, yet monetary policy must confront recent realities. And there, so assets that concentrate cash flows primarily in the distant future, like the high growth stocks with extended duration, will see their valuation compress as the discount rate increase. And we may ask, how can we continue participating in AI's long-term structural opportunities while simultaneously avoiding excessive aggression in a higher uncertainty environment? This necessitates a nuanced differentiation among different technology stocks. A broad brush approach is inappropriate. Like I said, the situation for technology stocks is quite inherently twofold. One aspect is the threat to the denominator, persistently high rates compressing valuations, and notably the argument that AI supports probability aligns closely with Walsh's core belief. Walsh is not a traditional inflation hawk. He harbors a more significant wager. He believes AI constitutes a structural anti-inflationary force. He underpins his belief with historical analogies that take us back to the productivity boom of the 1990s, before you were born. During that decade, or in the last century, as the internet transitioned from a novelty to infrastructure from 1994 to 2004, output growth averaged 2.7% per hour, while inflation concurrently declined. Walsh gambles Walsh's gamble is predicated on the notion that AI will replicate this dynamic, paving the way for rapid growth without triggering inflation. However, there is a crucial time lag involved. The immediate impact of AI manifests largely through substantial capital expenditures, like data centers, power infrastructure, bolstering demand and elevating related costs, while the productivity dividend, the manifestation of the numerator, requires a more extended period, a longer term, to fully materialize in corporate financial reports. Walsh is betting on a long-term productivity narrative, yet monetary policy must confront recent realities. This this underscores the importance of not treating all AI concepts uniformly, and prioritize maintaining an investment in AI leaders with current substantial profitability and cash flows. When interest rates are elevated and the cost of time escalates dramatically, and those companies that have already realized significant profit growth in their financial reports will see their numerator growth significantly outpace any valuation compression induced by the denominator of interest rates. They constitute the core of the continuing focus in our investment research work, in our investment research show. Adjust exposure to companies with high PE ratio requiring years for profitability realization. These companies have historically relied on optimistic expectations of rapid rate declines to sustain their high valuation. In the current environment, where the denominator is rising and the high rates persist, the risk of valuation compression is most pronounced. So the previously deduced hawkish maintenance with at most one defensive increase is not inevitably set to occur. It is premised on the condition that inflation remains sticky but not severe, and expectations remain anchored, and we must monitor several different indicators to determine sophistically if the narrative becomes unbalanced. First of all is the loss of continuity in core inflation. Should core PC sustain over 0.4% month-over-month growth for 2 to 3 consecutive months, pushing the annual growth rate back toward 4%, will cease to be noise and become a trend. At that juncture, the conclusion of dangerously but not controllably would be untenable. The second one is easing of inflation expectations anchoring. This represents a more critical signal than current data. The market, betting real dollars, focuses on the 10-year break-even inflation rates and the New York Federal Reserve's medium and long-term expectations. As long as these indicators progressively and consistently bridge historical ranges upward, it suggests that the risks of self-fulfilling spiral reminiscent of the 1970s are resurging. This is the singular trigger that would compel the Federal Reserve to abandon restraint and accelerate action. The third is the deterioration in the lack of employment. Do not overlook that there is another side of the balance. If the unemployment rate clearly bridges upward, or if the situation with the long-term unemployment shifts from a concern to a precipitous decline, the entire narrative will flip from inflation-dominated to recession-dominated. And totally, the narrative won't pivot towards greater hawkishness. Instead, it will sharply veer towards dovishness. Reflecting on history, the 1990s served as a stage for two narratives. It was both a script for insurance-style rate hikes and soft landings, as well as one of the textbook productivity booms. And before the back in the Web 1 era, many of our parents may benefited from the Web 1 era. Presently, Walsh enters the same room with dual faith in these narratives. If he succeeds, and AI does indeed bring about a productivity boom that autonomously cools inflation, The Federal Reserve may have the capacity to lower rates without igniting inflation, allowing the bull market to persist in a different guise. However, historians assert that while history does not repeat itself, it often rhymes, just as the rationale or the assumption of our technical analysis. The subtle differences between and within those similarities may harbor critical complexities and sophistication. One distinction lies in the fundamental differences between current and historical conditions. In the 1990s, globalization and inexpensive imports suppressed prices. Today, conversely, the forces at play are tariffs, deglobalization, or anti-globalization, and conflict, which are pushing costs higher. Furthermore, the current manifestation of AI primarily elevates demand, igniting a surge in data center development and increasing power costs, which in the short term may inevitably act as an inflationary catalyst. So we as investors, how should we position ourselves? The first recommended approach, no, this is not a recommendation. The first approach that we may consider is to avoid betting on a singular narrative and refrain from excessive aggression. Astute investors do not engage in debates over whether this trend ultimately results in major or minor keys. Treat high-quality AI leaders as our spear, as our guns, while using finance, energy, short-duration bonds, and gold as our AT field. This time, the harmony features tariffs, geopolitical conflicts, and inflated balance sheets, ensuring our safety in a dance floor, regardless of which chord resonates at the conclusion is indeed the most graceful posture. So you may think of the gold and when the gold drops, and like some cheap gold and short-term bonds, they can be treated as some defensive allocation. The recent price levels of long-standing DeFi leaders like Uniswap, Uni, and AAVG are nearing their ICO valuations, has sparked discussions about whether now is an opportune moment to buy in. Addressing this question requires our careful evaluation of the fundamental viability of DeFi as a concept. The core of the debate hinges on the resilience of DeFi's foundational principles: composability, censorship resistance, and decentralization. The emergence of advanced AI models capable of identifying vulnerabilities like the methods of cloud, which was temporarily banned by the government, has raised legitimate concerns about the security of DeFi protocols. If these security issues, cyber security issues, prove insurmountable, it could undermine trust in decentralized finance and drive users back to centralized finance CeFi, where custodial services offer an additional layer of protection or some legal protection. For investors considering AAVG or Uniswap, the decision ultimately depends on whether they believe that DeFi as a whole, the security challenges of DeFi are temporary setbacks or indicative of a deeper systematic fall. If one subscribes to the view that AI advancements will perpetually expose DeFi protocols to vulnerabilities, like the APT of North Korea, not South Korea. The APT means the national hackers, the official hackers hired by the North Korean government to steal money from the whole world. The long-term prospects for platforms like AV and Uniswap become bleak. In such a scenario, investing in these projects may lack substantive upside. Conversely, if you believe that these challenges are part of the growing pains of an evolving industry, and that solutions will emerge to bolster security and restore confidence in decentralized systems, then the future of DeFi remains promising. Under this perspective, platforms like AAVG and Uniswap are likely to play pivotal roles in shaping the financial landscape, particularly for individuals and institutions seeking alternatives to CeFi. Between the two, AAVG appears better positioned for sustained growth. Uniswap faces intense competition from centralized exchanges CEX like Robinhood and Coinbase, as well as decentralized exchanges DEX such as Hyperliquid and Pump.Fund. Uniswap's competitive mode is not as robust as one might hope, which could limit its ability to dominate the DEX space in the long term. AAVG, on the other hand, has more strategic opportunities. Its potential role is location as a back-end lending solution for CX platforms provides it with unique positioning and scalability advantages. So these are its modes. However, it is worth noting that competitors like Morpho and Spark are actively challenging AAVG's dominance in the lending space. For instance, Morpho has already secured partnerships with institutions like Coinbase, partly due to its innovative isolation mechanisms that appeal to institutional clients. In summary, whether or not to invest in AAVG or Uniswap depends on your belief in the future viability of DeFi. If you see DeFi overcoming current challenges and evolving into a secure financial system, then these platforms could offer significant potential. Among them, AAVG may hold greater promise due to its differentiation and strategic opportunities within the lending sector. However, investors should remain vigilant about emerging competitors and evolving market dynamics. And let us have a break for around 5 minutes, and when Weebearn is back, I'm going to talk about the SpaceX IPO. 本內容講係個人分享，講參考之用，並不構成要嘅銷售資料，由數為任何保證，亦不構成投資建議、專業意見。業務之內與香港推舉任何加碼貨幣投資有風險，投資標的價值可升可跌，個別不一定可預期將來表現，就做出任何投資決定前，投資應參閱相關上市文件做風險評估，並諮詢專業意見。本內容無意總有所述證券或投資牽涉任何風險。本內容所述資料根據獨立認為可靠的資料來源編製，而該等資料來源未經獨立核證，故不會就本內容為準確性或轉述，不需任何保證陳述或擔保。本內容無緣向派發本內容即觸犯法例或規例的司法權區或國家的任何人士或勢力派發，亦無意供該類人士或勢力使用。 Okay, I'm back. Let's read the SpaceX documentation together. Let's see. Table of contents. Let's start with the mission of SpaceX. You want to wake up in the morning and think the future is going to be great, and that's what being a space-faring civilization is all about. It's about believing in the future and thinking that the future will be better than the past. And I can't think of anything more exciting than going out there and being among the stars. Said by Elon Musk. So our mission is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. To do this, we have formed what we believe to be the most ambitious vertically integrated innovation engine on and off Earth, with unmatched capabilities to rapidly manufacture and launch space-based communications that connect the world, to harness the sun to power a truth-seeking artificial intelligence that advances scientific discovery, and ultimately to build a base on the moon and cities on other planets. So this is what a very beautiful mission vision statement look like. And if you are a startup founder or entrepreneur like me or like Elon Musk, you should learn about how to write a mission. So how beautiful it is. In Elon Musk's mission vision statement, it clearly illustrates his courageous his creativity, his sense of economy, and sense of the humanity. And we may also have a reference to the Kardashev scale, which evaluates a civilization by how much energy it harnesses. Whether it is for a level 1 civilization, it only harnesses most energy on its planet, which is our Mother Earth. So you may extract the fossil fuels, extract the geothermal energy, and also like actually all the wind energy, the energy from Earth comes from the sun. And like when the sunlight heats up part of the air, part of the atmosphere, and this may cause the flow of air, and this causes wind. And so that is the first level of civilization. And what the second civilization is about utilizing harnessing most energy of a star, which is our sun. We live in our solar system, and if we like build a Dyson sphere and capture most solar energy from the sun, and then we may claim ourselves as a second level of civilization. And intuitively, the third level of civilization is then to harness most of the energy in our galaxy, in our Milky Way. So this year there are several significant new initial public offerings, IPOs, entering the market, such as SpaceX in previous day. Last week, a pertinent inquiry is whether the more one invests in these offerings, the better the outcome will be, given potential returns, or whether it is prudent to exercise caution since an influx of high-profile offerings may absorb substantial market capital, potentially contributing to the overheating of the AI-driven bull market, reminiscent of the dot-com bubble in 2000, which is back in the early stage and initiated in the Web 1 era in the last century. In this discourse, we're going to utilize data alongside our Weebearn's experience in investment research to elucidate the dynamics of the IPO market. Specifically, I will address the implication of funds that are compelled to invest and why there is trepidation regarding the post-IPO performance of these commodities that would subsequently lead to market declines. The methods of participating in exchanges for inventory transactions are outlined as follows. Currently, there are three primary strategies for on-chain participants to invest in SpaceX within the blockchain market. First is pre-market tokens, such as the pre-SPCX of Bitget, SpaceX of at pre-stocks. The second one is tokenized share, namely the XStocksFi SPCXX, which can be accessed through Binance Wallet, Bybit, Kraken, and Bybit. The third one is perpetual contracts available on Binance Hyperliquid, Bitget, OKX, Bybit, Acer, among others. It is noteworthy that the token is recognized as a pre-token issued by Bitget in connection with the previous IPO of Prime, demonstrating a 24-hour trading volume of 200 million. Additionally, pre-stocks you may take an analogy to some pre-IPO. Pre-stock has indicated that following the IPO, the token will undergo a 1-to-5 stock split, which will be followed by a 6-month market discount period. Consequently, the current price reflects a discount approximately 10%. Once upon a time, the stock price, the pre-market token price reflects a discount of approximately 10% relative to the perpetual futures, and the 24-hour trading volume initiates at 25 million USD. The tokenized stock, most famous example is XStocks5, SPCXX. The Binance Wallet, SPCXX IPO campaign has a deadline on the 12th of June at 12 o'clock. General users have an allocation limit of $20,000, but those who meet the alpha points requirements for or possesses the NCLG badge can obtain additional limits. And the stake tokens are BNB Chain USDC with a minimum subscription amount of $100. The underwriting fee is 5%. The stake tokens are BNB Chain USDC. The underwriting fee is 5%, equivalent to a token price of 141.75. And the Bybit IPO Express campaign closes on the 11th of June at 22 o'clock. The minimum subscription amount is also 100 USDC, in addition to the underwriting fee. The final purchase price may reach up to 20%, with user confirmation required after the subscription is completed. And the most significant controversy in recent times pertains to the initial tracking of the stock, which was initially set at 11.87 billion shares, to align with the latest prospectus that state 13.08 billion shares. The exchanges need to execute price adjustments. Binance has currently completed the rebase record corresponding to 13.08 billion shares, while OKX has executed rebase concerning 12.52 billion shares. Both Bybit and Bitget opted to delist the old contracts before listing new ones. In contrast, Hyperliquid operates with no rebase capacity based on HIP3, thus leaving the adjustment of price differences to be reconciled by the market, with bulls absorbing the impacts. ELAV research indicates that this instance involved only about 10% of price gap, which is relatively minor. However, if future situations involve stock split, for instance, a 1-for-10, it could lead to significantly larger issues. The recent SpaceX IPO instance illustrates how participants in the blockchain market experience significant financial losses due to actions taken by these trading or launchpad platforms. Exchanges disseminated information asserting their ability to secure SpaceX IPO allocations, prompting numerous participants to invest funds under the belief that they will acquire new shares in the form of SPXCX. Ultimately, these participants were informed that no allocation was secured and refunds were issued, accompanied by transaction fees amounting to several $100s. And what is worse is that some investors, observing substantial pre-market increases in their SPCX pre-market contracts, opted to open short positions to lock in profits. Consequently, these investors faced the unfortunate outcome of being unable to secure the IPO, the initial public offering shares, resulting in notable losses from the short position, thus incurring losses on both spot and derivative trades. This strategy, or you may say, severely undermined the credibility of the concept of RWA, so-called real-world asset tokenization, that have been prompted within the cryptocurrency community for several years. So, if you would like to know more about RWA and how to get a RWA for your company, you may also watch our previous live stream of RWA. And let me share the links in the comment section, in the chat room as well. And our previous live stream explains how, as a Hong Kong entrepreneur or Hong Kong business founder, actually for big bosses, big business owners, you may consider using RWA to extend your potentials. Whoa, wait miss. Okay. It is probable that future attempts by platforms to promote the tokenization of US stocks or US IPOs will face skepticism from the cryptocurrency community. In essence, the crypto market has been severely exploited, leading to a situation where participants experience significant losses on 3 distinct occasions. The founder of of the Gen Z Vida announced that the 2x short position on SpaceX pre-market contract was open at a price of 162.46. This represents an approximate difference of 20.34% from the IPO price, with a position size of 200,000. He indicated that this position is planned to be held for a duration of 3 to 12 months. Initially, let's explore why the market exhibits such enthusiasm for these IPOs. The explanation is straightforward. The current market sentiment is exceptionally optimistic. I mean, TradFi in the traditional market sentiment. Of course, not the crypto sentiment. This scenario mirrors the post-pandemic bull market, during which market sentiment was similarly buoyant, empowering companies to capitalize on the fervor. Presently, the environment is characterized by increased investor risk appetite and optimism about potential returns. The more extravagant the narrative surrounding a product or service, particularly in sectors like AI, the greater the investor excitement. For instance, in May, a company positioned as a rival to NVIDIA in the AI chip sector staged the year's second largest IPO previously, raising approximately $5.6 billion. Despite an initial offering price of around 120, overwhelming demand escalated the stock price to 150, subsequently trading at 185, where an early investor realized a 19% return upon its debut at 350. This eagerness towards new IPO stems from the anticipated high returns associated with such offerings. And the most thrilling, most expected 3 significant IPOs, including companies that are widely recognized, such as OpenAI, SpaceX, Anthropic, with SpaceX stated to launch last week. Despite the AI chip company holding the title for the largest IPO year to date, projects up to May. SpaceX achieved significantly the highest valuations in history, underlying its status as an anticipated landmark event in IPO history. In addition to its size, SpaceX symbolizes a hot market trend embracing AI, encompassing aspirations like establishing data centers both on Earth and in space, and endeavors towards Mars colonization, which Weebearn is also very excited about. I'm looking forward. I can't wait to support the colonization of Mars and the outer space. So colonization is actually what brings the humanity to a higher level and improve the human civilization. And now is our time to join the colonization of space. Very exciting, very great. This narrative aligns well with the current exuberant market environment. On 12th of June, SpaceX was listed at a price of $135 per share, successfully raising $75 billion and achieving a valuation of $1.77 trillion. This figure represents 2.6 times the record set by Saudi Aramco in 2019. On the first day of trading, an influx of buy orders led to an immediate spike, closing the day at 160.95, reflecting a remarkable increase of 19.2%. Consequently, SpaceX market capitalization soared to $2.2 trillion on its initial trading day, surpassing both Tesla and JP Morgan, positioning it as the sixth largest publicly traded company in the United States. Additionally, Musk, holding approximately 40% of the economic rights, saw his personal wealth exceed $1.1 trillion, officially marking him as the first trillionaire in human history. However, beyond the figures lies a more intriguing structural design behind this IPO, which articulates how a company can maximize its control and valuation support within the existing rules of the capital market. The entirety of the $75 billion raised is allocated to SpaceX itself, as there were no existing shareholders selling stock in this IPO. This does not imply a lack of liquidity for employees, as SpaceX facilitated periodic internal secondary market transactions prior to the IPO, allowing employees and early investors to partially cash out, with the most recent occurring at an $800 billion valuation at the end of 2025. The structure of this IPO was devised to ensure that the company retained all the capital, rather than enabling insiders to exit. The intended use of the funds is explicitly for the expansion of the Starlink satellite network and for constructing space data centers and other AI computing resources. This choice effectively maximizes the company's cash flow and reflects insiders' confidence in long-term value. Furthermore, as the IPO did not involve selling pressure from existing shareholders, any subsequent unlocks can be executed more methodically over time. A noteworthy aspect of this IPO is the remarkably low initial public float of only approximately 4.3%, around 555 million shares. This signifies that despite SpaceX's $1.7 trillion valuation, only around 75 billion worth of stock is available for trading in the market. And you may take an analogy to the flowing counterpart in cryptocurrency, leading to oversubscription levels of 4.6 times, pointing to nearly 275 billion in funds that were wishing to buy but could not. This mirrors the strategy seen during the ARM IPO in 2023, which also released minimal equity, amplifying its extremity. This low float creates a scenario conducive to price support from a supply-demand perspective, When demand far exceeds supply, upward pressure on price naturally ensues. And data indicates that the subscription amount during this IPO surged to 350 billion. So the oversubscription level is 4.6 times, which indicates that nearly 275 billion in funds were wishing to buy but could not. And these were the buying pressure or potential bid order. The funds that were sidelined most directly filtered into the secondary market following the IPO, elucidating the reason for the substantial price increase on the first day, amidst significant demand pressure. However, a low float represents a double-edged sword, as similar imbalances in supply and demand can result in amplified declines in the face of negative real news or shifts in market sentiment. In the short term, it resembles a high beta, story-driven trading asset. Typically, retail allocation in large IPOs ranges between 5% and 10%. But as I've mentioned in our previous live stream, in this instance, SpaceX allocated 30%, with platforms such as Fidelity, Schwab, and Robinhood, lowering the threshold for participation. This is attributable to Musk's personal brand influence, his impact on social media, and the loyalty of Tesla's shareholder community, and though SpaceX with a ready and highly engaged retail investor base. And also, it's because Elon Musk is a very caring, and he cares for the poor, so he allows more wealth opportunities, more opportunities for the common people or the poor people to become rich, to get rich, instead of letting those Wall Street institutional investors controlling all the earning opportunities. And learning the allocation toward this group is both strategic and opportunistic, as retail investors are typically more resilient to short-term volatility and may even choose to buy more during declines. This is a case for some on-chain whales, some crypto whales. So you may see that every time when the crypto market drops, or like when Bitcoin or Ethereum declines, those on-chain whales, those DATs like Hermes, ETH DAT, or like MicroStrategy strategy, they'll buy the dip. The dominance of retail participation implies a high emotional volatility or sentiment volatility. Discussions on social media and Musk tweets are likely to influence prices in the short term, rendering traditional fundamental analysis less reliable and indicating that SpaceX stock price movements early in its market presence may more closely resemble that of a meme stock. And this brings about another money management opportunity or money earning opportunity, and we may make money by copy trading or by tracing Elon Musk's tweet, Elon Musk X. Just like when we do the Trump trade, or when we trade Dogecoin. Prior to this IPO, an essential debate arose regarding market rules. Initially, it was anticipated that the S&P Dow Jones indices might adjust regulations to rapidly incorporate this colossal offering into the S&P 500. However, in early June, S&P firmly declined, citing that SpaceX would still be in a GAAP loss state by 2025, failing to satisfy the S&P 500 requirements of 4 consecutive quarters of profitability. Based on existing regulations, SpaceX's earliest qualification for inclusion is projected for 2027, provided the company achieves profitability during that span. The S&P's rejection eliminated a potential major source of passive buying pressure. However, conversely, Nasdaq pursued an alternative route, modifying rules in May to incorporate newly public companies ranked within the top 40 by market capitalization into the Nasdaq 100 after only 15 trading days. The previously required 10% minimum float was also waived. For low float stocks, Nasdaq permits the use of a 3-fold multiplier to enhance weight, artificially amplifying their influence within the index. So you may consider this may be a tailor-made for SpaceX or some nice IPO stocks. This 3-fold multiplier stands out as a design innovation. Without it, a 4.3% float would render SpaceX's significance in the index negligible, as you may see it. Before, many people argued that although Nasdaq or index investment automatically allocate my capital in the most growing stocks or most prominent stocks. However, the proportion of SpaceX is still negligible. However, the existence of this multiplier grants an estimated initial weight of between 0.47% and 0.7%, potentially reaching 1 to 1.8% under certain scenarios. This gives the volume of passive buying ultimately hinge on this estimated weight, dictating the scale of influx into the stock, which is critical for assessing shorter movements. The core calculation is straightforward. SpaceX weight in the Nasdaq 100 multiplied by the total assets tracking the index. Initial estimates place SpaceX predicted weight at 0.47% to 0.7%. Meanwhile, the current assets under management for the Invesco QQQ alone are substantial, amounting to between 475 billion and 500 billion. With additional amounts from QQQM and various mutual funds, institutional accounts, and derivative ETFs contributing to a total of approximately $1.4 trillion tracking the Nasdaq 100. Multiplying the weight estimates by this total suggests that passive buying derived from core QQQ related instruments may range between $7 billion and $10 billion, including the broader Nasdaq 100 trading ecosystem. The total passive buying scale would range from 20 billion to 27 billion. It should be noted that SpaceX's initial float was roughly valued at 75 billion. So our estimation indicates that short-term passive buying within the coming 1 to 3 months could escalate to approximately 20 billion to 30 billion. This infers that passive buying may constitute 25% to 40% of the overall float. In other words, within the next 4 to 8 weeks, there may emerge an influx of forced buying equivalent to more than 1/3 of the initial float. This proportion is strikingly high, yet it does not account for the enthusiasm of retail investors, proactive institutional buying, nor those who are frustrated by the IPO's limited allocation are positioned to capitalize on price increases. Contrary to the common misconception, passive funds do not execute their purchases in a lump sum on the declaration day of index inclusion. So the next rich mindset, the next financial education concept you have to consider about is the rebalancing mechanism. The operational mechanics are notably intricate. Index providers typically announce the incorporation date in advance, allowing fund managers, those fund mans and ETFs, to discreetly accumulate shares in stages beforehand to mitigate market impact and tracking errors. Talking of market impact and tracking errors, Weebearn has drafted a simple VWAP algorithm, volume weighted average price, which is the benchmark or the baseline price where institutions consider about accumulating a stock. So if you are interested in some beginners level quant trading or algorithmic trading, you may join our Discord community, our anime and comics and games community, and there you may get Weebearn's Python code in Google Colab, where I coded for a VWAP algorithm. On or around the inclusion date, significant trading volumes frequently manifest as funds strictly aligning with the index adjust their positions at the last minute. During this period, ETFs also utilize the creation and redemption mechanisms via authorized participants to absorb some of the large transactions of market, lessening the direct pressure on the public market. Just like some block trade in the crypto market, they may be executed by some dark pools or like OTC, over-the-counter trade. This phenomenon, known as repositioning, allows for a smoother transition for a of capital, just like the VWAP algorithm written by me, or some smart routing algorithm. If you consider the venue domain or the exchange domain. Historical cases such as Tesla's inclusion in the S&P 500 in 2020 provide us an informative comparison. Following the announcement in November with a formal implementation on December, Tesla's price surged by approximately 57% within the month due to proactive buying pressure from passive funds. While on the inclusion day, the market witnessed a staggering volume of 222 million shares traded. Currently, SpaceX navigates a situation where the pressure of financial inflow is even more intense than Tesla encountered at that time, primarily due to its significantly thinner flow of just 4.3%. Moreover, Nasdaq's allowance of a threefold weight multiplier further exacerbates the situation. The fast-track rule appears tailored specifically for SpaceX. Just as I've mentioned, it is anticipated that by early to mid-July, approximately 15 trading days post-IPO, passive funds like QQQ will formally initiate their purchases. However, institute funds will not remain idle, as the activities of passive funds and arbitrageurs engaged in pre-positioning have already commenced since the IPO listing on 12th of June. This activity largely classifies why SPCX managed to deliver an impressive 19% gain on the first trading day amid such substantial market conditions. In the lead-up to the IPO, SpaceX disclosed two substantial AI computing capacity rental contracts, providing tangible revenue support for its valuation. The first contract, signed with Anthropic in May 2026, entails a monthly payment of $125 million for utilizing the compute power of the Colossus data center acquired through XAI. The second contract, revealed on 5th of June, involves Google, which will pay 920 million monthly from October 2026, leveraging approximately 110,000 NVIDIA GPUs, totaling a contract value of 30 billion. Projected revenues for SpaceX in 2025 amount to approximately 18.67 billion, yielding a trailing price-to-sales ratio nearly reaching 100 times, with a 1.77 trillion IPO valuation. So for a company which haven't got its earnings yet, we cannot calculate its PE ratio, or like for companies with a non-positive earning. So we calculate its PS ratio, that is the price to sales ratio instead. Although it is less intuitive than the PE ratio, it serves as a alternative when assessing these startups or newly emerging tech giants. Under conventional valuation methodologies, this figure undeniably appears inflated. Nonetheless, these contracts substantially alter the future revenue trajectory. Once operational by 2027, revenues from Google and Anthropic alone are expected to amount to 26 billion annually, surpassing SpaceX's total revenues from 2025. This implicates several key insights. Revenue diversification signifies that SpaceX effectively converts high asset investment in AI infrastructure into a high-margin subscription-based income, illustrating that it transcends the characterization of merely being a space and satellite communication entity. The agreements with Google and Anthropic mitigate risks associated with AI investment, validating Musk's previously aggressive data center expansion as not being mere unfounded speculation. Future valuation optimization suggests that while 2026 revenues may initially contribute minuscule amounts, significant influxes commencing in 2027 and 2028 will lead the forward price-to-sales ratio to decline substantially to between 40 to 60 times, rendering presently exaggerated valuations relatively justifiable. Nonetheless, caution is warranted as both contracts contain 90-day termination clauses and expire mid-2029. Hence, this income is not an unequivocal long-term assurance, requiring SpaceX to continue demonstrating the irreplaceability of its computing services in the coming years. SpaceX has adeptly avoided the conventional IPO 180-day wall associated with lockup periods, leading to potential dramatic downside pressures upon release. Instead, it employed a tiered and performance-linked unlocking structure, allowing for measured supply release. Following the first earnings report, approximately in August, up to 30% of the locked shares may be released. Subsequently, every interval, 70 days, 19 days, 105 days, 120 days, and 135 days, releases an additional of 7%. An unlock of 28% will occur post the third quarter earnings report. The majority of early shareholders lockups will conclude after 180 days, whereas for Elon Musk himself and certain major shareholders will have to abide by a 366-day lockup. The rationale behind this design is to ensure that supply does not flood the market all at once, but rather increases predictably in waves. Just like tokenomics, each unlocking event carries the potential for sell pressure, but simultaneously enables adequate preparation for these occurrences for the market to price in these lockups. As the flow gradually expands, stock volatility is theoretically expected to diminish. Liquidity should improve, and index weight calculations will more accurately reflect market valuations. This outlines a transition from a premium associated with a low float stock toward normative large cap stock behavior. a process that may require 1 to 2 years. This IPO has imparted several lessons. In the short term, meticulously dissecting SpaceX fundamentals, financial models, or valuation multiples may not yield considerable insights. The combination of an extremely low float, a high level of retail engagement, and Elon Musk's unparalleled social media influence underscores a critical reality. That is, the stock's trajectory in its nascent market period will predominantly be governed by market sentiment. This is not merely a numerical exercise, a numerical model in accounting or analysis. It is a context characterized by faith, fund supply-demand interactions, those rebalancing mechanisms, and collective psychological phenomena, whether stemming from the substantial computing capacity agreements with Google and Anthropic, or advancements related to the Starship launches. These elements merely serve as fuel for the emotional fervor, rather than serving as precise determinants of share pricing. For investors, it may be more beneficial to comprehend the essence of this endeavor, rather than attempting to rationalize its price via traditional financial metrics. Consequently, this journey is destined to be dictated by sentiment and supply-demand dynamics, epitomizing the authentic rules of engagement for this unprecedented IPO. Upon reflection, it is essential to analyze IPO performance through empirical data or historical data. Research derived from a professor at the University of Florida collates data from IPO spending from 1980 to 2025, revealing that newly public companies typically experience an average gain of 19% on their debut date, with a 25-year average increase of 29% on a yearly basis. This historical perspective illustrates a generally positive initial performance for IPO. However, several caveats are critical to acknowledge. Firstly, historical performance does not guarantee future results. While IPOs have demonstrated average positive first-day returns historically, this trend does not necessarily predict consistent outcomes moving forward. Moreover, it is crucial to clarify that Weebearn I am not providing investment advice either for or against participation in IPOs. Rather, I am analyzing market trends based on the available data. And so this channel, this program serves as only a academic and for entertainment purpose. And secondly, although the overall average return is positive, it does not imply that every individual offering will yield gains. The data also reveals that approximately 24% of IPOs experience declines on their debut, with this figure escalating to 35% over a 25-year period, indicating that more than half of IPOs see their sharp share price drop initially. Furthermore, when analyzing the performance based on company size, an intriguing pattern emerges. Larger firms, specifically those generating revenues in excess of 500 million, typically underperform relative to smaller entities on their first day of trading, just like Minimax in Hong Kong Hang Seng Index. For context, SpaceX operational income last year amounted to 18 billion, categorizing it firmly within the larger company bracket. A comparative analysis of IPO outcomes as per their underwriting institutions highlights that offerings managed by top-tier investment banks such as JP Morgan and Morgan Stanley generally realize first-day price increases averaging between 25% to 26%. compared to those handled by less prestigious firms like Citibank or Barclays. Looking ahead, it remains to be seen which firms will dominate forthcoming IPOs. Another noteworthy data point reveals that despite the attractive returns from newly public companies, for those holding investments over 3 years, the average gain is merely 7.6%. While this may initially seem favorable, market adjustment indicate that when compared to broader market performance, their returns are incongruently less favorable by approximately 25.5%. This context frames a critical decision for investors. Should one participate in the purchase of new IPO shares considering potential market disparities? And what it means is that although you can averagely earn money by participating in IPO, you earn slower than the overall index, than the whole market benchmark. And so you should not focus only on IPO. You should invest in indices. Given that the average, this is a common benchmark for money management. So if you cannot earn quicker and faster than the market indices, than the whole market, why don't you just invest in market indices itself, like invest in QQQ? Given that the average IPO yield is 20%, does this imply that we should always participate in stock allotments? While I refrain from providing investment advice regarding whether to subscribe to new shares, I can share my research experience to illustrate how institutional investors they may navigate this landscape. For large-scale funds, particularly hedge funds, they employ dedicated portfolio managers to devise their investment strategies, often compensating them with salaries in the millions to pursue stock subscriptions. This is grounded in the understanding that stock subscriptions have a threshold. Historical data suggests that over the past few decades, the average performance of newly issued stocks has demonstrated upward trends. Whilst it's acknowledged that some stock will increase in value and others will decrease, the collective average return from widespread participation stands at around 20%. However, if this process were simple, then the rationale behind allocating substantial funds for managing these strategies would be questionable, owing to the complex nature of actual operations. To effectively participating in this subscription process, one must possess keen discernment. The average return does not guarantee uniform allocation across all stocks. Just like our life, lastly, we mentioned a concept called ergodicity. The temporal mean does not it is not equal to the spatial mean, and what we mean in stocks is that the average return across all stocks does not infer the average return over a long period of time for a single stock. For instance, if one is unable to secure shares in highly sought after stocks, yet acquires an abundance of underperforming ones, one's average returns will diverge significantly from the statistically reported average returns. And this is also reasonably you can deduce it from the path-dependent nature of stocks or stocks price dynamics. And if you would like to for beginners like children who are interested in money management, I recommend you to watch our time series money management series, and we'll introduce some basic concepts regarding time series analytics. That is crucial and essential for money management. And to put simple, money management is all about economics and resource allocation. So you have to model the risks and also model the price dynamics over different time series data. And so determining which stocks to subscribe to entails discerning which are favorable and which are unfavorable, which are the strong and stocks, or which are the weak stocks. Moreover, when navigating through the subscription process, one must also process the capability to secure larger allocations of desirable stocks. So you may learn a lesson from those RWA tokenization. There's a risk that you cannot actually get the offerings, and besides its oversubscription, there may be some third-party risks and some centralized risks where the platform cannot offer you enough allocation of the stocks, and that is very bad, especially for hedge funds when you have a hedging position. So in the beginning of this session, I have mentioned that many tokenized stock investors suffered heavy losses because they didn't actually get their expected allocation of SpaceX IPO shares, but they attempted to secure their so-called earnings, 套保, by opening some short position, and they suffered from heavy losses in their short position. And they may also face some liquidation risk, which is known as zatsudan in Cantonese. And therefore, institutional investors function within a framework that provides them with distinct advantages. And why they would not suffer from these mistakes or these challenges is that this is largely attributed to the presence of a strategic fund manager within these large funds, who is often already engaged in numerous transactions, and also they have advantages in their capital. And so often in no matter primary market IPOs or in secondary market, the execution mechanism, they enjoy an advantage in execution. So their order will be firstly paired, or that is called the power of execution. They're just like in poly market. Why retail traders cannot arbitrage, while retail arbitragers cannot earn as much as those professional institutions? It's because their execution, the capital execution and the order pairing algorithm execution. Let me explain in Cantonese. 所謂執行力就係本金執行力，仲有呢個訂單匹配機制嘅執行力。The order pairing mechanism. Like in traditional finance, 一啲機構嘅訂單會優先被匹配，佢哋會有優先匹配，特別喺盤前啊，或者係一啲呢啲咁好賺嘅市場入面，而訂單匹配嘅優先權就係執行力嘅好重要嘅一環，而佢亦都係資本執行力呢個資金優勢嘅其中一個面向。就正如喺 Poly Market 嗰度，好多人就會咁用 Poly Market 嘅 API 做交易， 但係一啲更加實力雄厚、更加資金雄厚嘅，佢哋會用一啲更快嘅匹配機制去更快咁樣去搶先喺個區塊嗰度完成佢哋嘅訂單。Okay, let's talk about SpaceX. This is largely attributed to their advantages in their capital and their trading experience. That is where the value of fund managers lie in. Consequently, when an attractive IPO arises, numerous funds aim to secure larger allocations due to their established relationships and the substantial commissions they generate annually for brokerage companies, allowing them to leverage their influence and acquire more favorable terms when they do their negotiations. 即係賺錢嘅好多都係講關係。咁如果你資金實力雄厚，你嘅認購即係參與呢啲 IPO 嘅機會嘅經驗比較豐富，好似嗰啲一線投行咁樣，咁你就比較有機會接觸得到呢啲優先賺錢嘅機會。咁呢個就係資本圈子呢個圈子嘅有效人物嘅力量，或者呢個尖端人物嘅力量。The power of the cutting edge interpersonal relationships. 即係好多理財嘅嘢其實係講人際關係同埋講一啲機構之間嘅訂單匹配機制。Another dimension pertains to passive income funds that necessitate the acquisition of new shares. Highlighting the prospective interest surrounding SpaceX is that the company has aspirations to raise $75 billion, yet the current demand for its IPO has exceeded 150, and positioning the company among the top 10 enterprises in the US. And lately, even the 6th largest enterprise, and up to 300 billion US dollar demand. However, its revenue, which amounted merely $18 billion last year, correlates to a price to sales ratio of 100, as above mentioned. And while this raises concerns about its valuation, such valuation, though intensely debated by those analysts, especially those value investors, bring forth the question of why institutional investors remain fervently vying for allocations. One rationale stems from the fact that numerous funds, particularly like those long-term ones, and those tracking indices benchmark their performance against the Nasdaq, necessitating the purchase of stocks comprising this index. And again, I will recommend you to focus on the coming several months, or even it is projected that the passive index tracking funds will require the acquisition of stock value between 12 to 18 over the 3 following SpaceX IPO. And if SpaceX satisfy the conditions for S&P, they may even be launched on be included in the SPX in next year, or at 2027. While participating in IPOs, new stocks offerings can elicit enthusiasm akin to lottery games. Various concerns arise in the days following. The first concern relates to the direct impact of these IPOs, primarily due to the substantial influx of capital, such as for companies like OpenAI and VTubers. and they have to engage in intensive capital outlays. The competitive landscape pushes these technology giants not only to safeguard their market position or their market allocation, but to invest significantly in developing AI capabilities. It is anticipated that this year's capital outflows will surpass those of the previous years, as entities grapple with capital requirements. Concurrently, apprehensions heighten among major tech firms regarding maintaining their dominance, thus necessitating increased spending to navigate the demands of AI advancement. Increments in investment from companies such as Google and SpaceX reflect an overarching concern for preserving market share amidst competition. So, SpaceX represents only one of many players amidst an anticipated forthcoming surge in IPOs, with a forecast suggesting potential market supplies approaching $200 due to IPOs, stretching to $500 in the ensuing year. Such figures evoke considerations of market pressure under the weight of forthcoming share supply. Should insufficient capital be present to absorb this influx, resulting in probable downward price adjustment across various stocks. And another thing I would like you to notice or to learn from about is this shares allocation. Elon Musk is a very long-sighted, very smart and wise entrepreneur. I mean, all bosses are smart because so that they can become a boss. But Elon Musk is smart even among the bosses. 所有老闆之所以做到老闆，都因為有智慧、有遠見、有聰明。但 Elon Musk 喺芸芸眾多嘅老闆之中，係更加係最聰明、最有遠見同埋最有智慧。And this can be viewed from his stock allocation. In previous two offerings or two companies, Elon Musk has suffered from dilution of his power, dilution of his voting power. For example, 上市嘅其中一個唔好處就係會稀釋你嘅權力，稀釋你嘅決策權同投票權。So this time, Elon Musk made a very smart and wise move. So for SpaceX, there are three categories of stocks, and each category A stock grant 1 voting power, while each category B stock grant 10 voting power, 10 times that of category A stock, while category C stock does not give any voting power. And most stocks held by Elon Musk, of course, the category B stock. And also in his compensation, let me find that page for you. So even after IPO or all the stocks are traded on the market, Elon Musk still hold decisive power. Still retains its absolute control over the company. And for founders like you and me, we may take reference to this share or equity structure. it's like the money management skill of equal share but unequal right in Chinese 同股不同權嘅理財技巧，或者一個同股不同權嘅理財技術。Elon Musk talks about his engineering first enterprise culture. Let me find this reverse mechanism. Yeah, we have talked about its three main brands in previous session. So let me repeat again. There are three major branches of SpaceX, namely the space. They offer launch services like the Falcon 9 and Falcon Heavy rockets for satellite, cargo, and crew mission. The second one is connectivity. There is the Starlink consumer broadband, enterprise solutions, government solutions, and Starlink mobile. And actually, Starlink has its philanthropist meaning, or is so is very beneficial to the society. Like in some dictatorships in Middle East, people cannot access to the internet, and that's where they need Starlink. And so Starlink is actually a great contributor to democracy and freedom, and also it helps in the Ukrainians in the Russia-Ukrainian war. And the third one is XAI, the AI sector. And these are those costs they inferred in the in the previous year. And we have briefly covered that before. Okay, here are the critical part that I want you and me myself to learn about. This is the capital stock. In the common stock, 普通股, and each holder of Class A common stock is entitled to 1 vote per share, whereas each holder of Class B common stock is entitled to 10 votes per share. Class C common stock have no voting rights. Generally speaking, and they have three classes of stocks, and respect to matters to be voted on by shareholders of the company. Holders of all classes of the voting common stock will vote together as a single class. And these are all the important points that we should know about when managing our own equity. Notwithstanding the foregoing, the charter provided, as further described below, the holders of Class B common stock, voting separately as a class, are entitled to elect 51% of the total number of authorized directors, rounded up to the nearest whole number, and removal of Mr. Musk from his board and leadership roles. Chief Executive Officer and Chairman of our board requires the approval of the holders of at least a majority of the voting power of the outstanding shares of Class B common stock, voting separately as a class. What this means, Elon Musk himself is actually the largest shareholder of those Class B common stock. 呢個意思就係、如果你想炒咗 Elon Musk，就係將佢踢出領導同埋領導同埋董事會嘅話，你就需要有大多數 B 類股份嘅同意。咁但係 Elon Musk 佢自己就係呢啲 B 類股票嘅大股東，咁所以佢就可以坐穩佢個位啦。In addition to any other requirement under our charter, the approval of the Class B common stock, voting separately as a class, is required to approve any amendment to our charter that would make any change in the rights, powers, preferences, and privileges of the Class B common stock, and certain combinations, mergers, or sales. And this actually consolidated Elon Musk is his rights, powers, and privileges, and to make a long-sighted decisions for the company, instead of being subtitled or being interfered by the short-sighted market dynamics. 呢個就可以鞏固到 Elon Musk 先生佢嘅自己嘅權力啦，佢嘅特權，佢嘅權能，可以為公司作出長遠嘅決策，就好似一個君主咁樣，一個賢君咁樣。咁因為君主係終身制嘅，咁佢就唔會因為一啲短視嘅人、一啲短期嘅波動而干預佢嘅決策，咁就可以作出一啲更長遠而嚴明嘅一啲決策咯，即係actually he learns from some past experience, and in the early stage when Elon Musk founded Tesla, and even earlier when he founded the PayPal, he faced some debate over the board of directors, and he have suffered from some challenges to his rights. 喺 Elon Musk 創業初期，佢曾經面臨過對佢管治威信對佢權力嘅挑戰啦。喺佢嘅過去嘅管理層嗰度，即係例如喺佢早期Tesla，甚至更嚴重嘅就係喺PayPal 嗰陣，甚至動搖咗佢喺董事會入面嘅地位。咁所以 Elon Musk 今次嘅呢個咁聰明、咁有智慧嘅股權分佈，就可以鞏固到 Elon Musk 喺佢自己心愛嘅 SpaceX 嗰個地位，就唔會因為股權稀釋而將公司嘅決策權俾一啲短期嘅市場波動去左右到。That is a lesson that we as founders should learn. 呢個就係我哋作為創辦人，我哋作為管理者應該要學習嘅一啲管理學嘅智慧啦。According to the latest exclusive report from the Wall Street Journal, OpenAI is poised to reduce prices in an effort to attract customers. This strategy is anticipated due to expectations that Anthropic will also lower its prices, prompting OpenAI to take preemptive action. Does this indicate that the narrative of AI monetization is coming to a halt? Is this possible that enterprises are unwilling to invest, forcing the industry leaders to engage in price competition? So, there are actually 3 practical business considerations behind this move. Explain to why OpenAI decided to lower its prices. The first reason is as a defensive measure, countering Anthropic's advantage among software engineers over the past 6 months. Anthropic, through its core product or Code tool, Code Harness has significantly captured the attention of the software engineering community with automated programming, web coding, and AI assistant tools, which has led to substantial revenue growth. And at times, its valuation has approached or by some accounting consideration exceeded that of OpenAI. It's just a matter of how you count its revenue. 我哋之前中文嘅閱讀集團市場集團曾經講過，喺今年年初 Anthropic 曾經一度佢嘅收入係超越咗 OpenAI， 咁但係喺呢度個收入有歧義，因為喺 OpenAI 計算收入嗰陣咧，佢係將分拆俾一啲一啲中介商啊，例如一啲雲端服務嘅 infra 嘅成本扣除咗之後，先至計算為佢嘅收入。但喺 Anthropic 嘅財報入邊咧，佢就先計一個收入，然後將一啲分拆俾中介商、分拆俾雲端平台嘅中介費，另外計成一筆嘅支出。And the second reason behind is the corporate client budget concerns. By mid-2026, corporate attitudes towards AI have shifted from initial unrestrained enthusiasm to a more cautious, budget-conscious approach. Many companies that excitedly integrated various AI assistants at the beginning of the year are now facing surging operational costs, with annual AI budgets depleted within months due to unrestrained usage by employees. OpenAI CEO Sam Altman acknowledged that at the beginning of 2026, there were no complaints about costs, yet currently, the most frequent request from clients is for reducing the price. Lowering prices is a strategy aimed at alleviating the concerns of CFOs wary of dwindling budgets and questioning the value of AI investment. And the third reason behind is the land grab ahead of an IPO. It is important to recognize that both companies are on the verge of going public. OpenAI has recently submitted its confidential IPO application, with Anthropic following suit shortly thereafter. At this critical juncture, rather than just a favorable profit margin, the public market investors are primarily interested in identifying the undeniable dominant player in the industry. By reducing prices, clients are likely to become heavily integrated into OpenAI's ecosystem, making it more challenging for them to switch providers in the future, creating a narrative that is attractive to investors. 咁呢度我亦係短暫用白話用廣東話講啦。咁呢個亦都係一個理財嘅智慧嚟，就係我哋憑住我哋嘅雄厚實力財力去砌低一個對手啦。好似如果你講到好衰咁就係咁，因為 OpenAI 同 Anthropic 今年都要上 IPO 都要上市啦。咁佢哋其實要話俾成個公開市場嘅投資者，邊個先至係個大佬，邊個先至係龍頭，而龍頭最大咁樣先至可以吸納到最多嘅資金。咁所以喺短暫犧牲一啲盈利，甚至可能就算俾我嚟講啦，哪怕蝕住做，咁樣都係值得嘅，就係為咗快速打個市佔率翻嚟，佔據個市場，去好等 投資者對我哋作為龍頭企業有更大嘅信心啊。This does not signal a weakening demand for AI. However, interpreting this situation as evidence of a peak in the AI market or the so-called AI boom is misguided. Over the past 16 months, the per unit cost of AI usage, known as the token pricing, has been consistently decreasing. For instance, in the case of top-tier models, the cost of producing the same amount of text has fallen by over 18% within just over a year, while input costs have dropped by nearly 90%, yet overall corporate AI expenditures have increased rather than decreased. Research indicates that while the computational costs of elite AI have plummeted by 98%, corporate AI budgets have more than tripled. The reason is straightforward. As costs decrease, the AI usage per employee has surged by 18 times. Another report shows that although the average AI usage price for enterprises has dropped nearly 70% annually, their total AI budgets continue to expand due to explosive growth in usage. New AI assistants and automated frameworks require significantly more computational resources, 5 to 30 times more than traditional methods for each task. This phenomenon exemplifies what has been referred to as Jevons paradox in this AI field. In summary, when technological advancement drastically reduce the cost of a resource usage, instead of conserving it, users will explore more innovative applications, leading to an increase in overall consumption rather than a decrease. 咁呢個我哋喺早前普通話嘅集談嗰度都有講過呢個 Jevons paradox 傑文斯悖論個意思就係當一樣資源嘅價格下降因為佢嘅效率提升嘅時候比起慳咗呢樣資源大家總共使用呢個資源係會用得更加多，所以用出嚟個總支出係會更加大。呢個本身就係嚟自於黃仁勳張新芳佢喺我哋陣講到上次講到 GTC 2026提出嘅一個理財嘅見解。咁對於我哋做 financial management 做 money management 嚟講咧，就係如果有一樣嘢平咗嘅話咧，我哋好多時候反而值得更多去使用嗰一個資源。咁就好似我哋例如一個好簡單嘅理財問題就係你會想請個人去做一樣嘢，定係想安排一個你會想請個工人去幫你做家務，定係安排一啲機械人去幫你做家務？咁如果當機械人變得咁平嘅時候咧，反而你可能會用更加多嘅支出喺請機械人工人去幫你做家務嗰度。咁樣係因為原先你根本就未必會請機械人做你工人姐姐去幫你做家務，但係如果機械人變得咁平嘅時候，咁個資金嗰個本金門檻下降咗，咁你就會願意去請呢啲機械人去做你嘅工人姐姐幫你做家務。咁對於成個市場嘅而言，亦都係咁樣。就係原先可能好多人都因為本金門檻而用唔到 AI 去做理財，咁而家人人都因為 AI 變得咁平，而開始用 AI 嚟去幫我哋揾錢，去取代一啲最好做嘅任務。It is believed that the recent trend of token price reduction will also validate this Jevons paradox principle, and in which a slight decrease in price could result in a considerable increase in usage, subsequently leading to an overall rise in expenditures. This illustrates that the AI market is not contracting, but instead expanding rapidly. So the question arises, will a price war among model providers undermine the entire AI market? The answer is quite the opposite. This situation is highly favorable for nearly everyone outside of the model providers. This mirrors the early stage of the internet or cloud computing. When Amazon and Microsoft drastically reduced cloud service costs, cloud computing did not falter. Instead, it experienced explosive growth and adoption. As AI becomes significantly more affordable, enterprises are likely to develop an increasing number of AI assistants and AI agents. They operate around the clock. This implies a higher demand for chips for computational power, as well as other types of hardware such as memory. The sectors more likely to benefit include those already facing constraints such as energy. The resultant surge in AI usage driven by lower prices will exacerbate the already strained demand for power within electrical grids and data centers. In a context where trial and error costs have substantially declined, where complex tasks previously costing $10 now only cost $1, this trend could further accelerate the integration and deployment of AI across various industries. And here, let me also teach a financial management concept, and that is, in order to make money or in order to learn how to make money, you have to put money into the market and verify or your hypothesis, and you have to do experiment in order to learn how to make money, and you use your capital to make an experiment. And it may not be very large, but we have to allocate our capital and test our hypothesis, and then find out our way of making money。就係講緊我哋一個財商重要嘅財商概念啊，就係我哋要理財或者學習理財，好需要真金白銀投放喺個市場上面做實驗，去驗證我哋嘅假説。而只有當我哋真正投放我哋嘅資源、投放我哋嘅本金喺個市場上面去驗證，或者倒翻轉頭去試錯嘅話，即係去正反我哋嘅假説，咁樣我哋先至可以更有效咁樣去管理到我哋嘅資源，同埋學到真正嘅賺錢概念。所以我哋好值得去學習去呢啲嘅企業啦，就係去可能去將我哋嘅錢去用我哋嘅零用錢去買一啲數據中心啊，去買一啲人造衛星翻嚟。Nonetheless, a time-sensitive complication emerges. Both OpenAI and Anthropic have secretly filed for IPOs in early June, aiming for a simultaneous entry into the public market. Both companies currently hold high valuations but are suffering significant losses. The emergence of price competition poses a challenging narrative for these firms as they prepare to face public market investors. The first is the questions of pricing power. Given their high valuation, investors will demand evidence of sustainable competitive advantages. Aggressive price reductions could signal to the market that these AI models are becoming increasingly interchangeably and can be easily substituted. This undermines the assertion that our technology is superior, justifying a high price. And this also applies to our money management concept, our rich mindset concept, that our inherent money-making ability or capability of revenue lie in our pricing power. Whether we can earn a income, earning or not, depend on whether we are non-fungible enough, not replaceable enough, and whether we hold our pricing power。 呢個亦都係一個富人思維啦，就係理財係在於決策權，在於定價權。我哋賺唔賺到錢嘅關鍵就在於我哋掌唔掌握到呢個定價權。 所以如果大家想賺你哋嘅收入或者賺你哋嘅錢嘅前提，就係你首先要揾一個你決定性嘅敏感技術，一個關鍵性嘅敏感技術，你要揾出你獨特嘅競爭優勢，你要思考出你嘅獨特競爭優勢。而之後，當我哋掌控咗呢個決策權，即係我哋可以掌控咗呢個定價權，我哋可以決定我哋賣出嘅嘢以乜嘢價格賣出去，我哋可以控制個價格嘅時候，我哋先至真正咁掌握到呢一個收入。A counterexample is that a common employee, they do not have a pricing power, and that's why they stay poor over a long. They will always stay poor. 一個反面例子就係通常一啲僱員佢哋並冇一個定價權，所以即係佢哋冇辦法去決定佢哋嘅人工，所以佢哋就會一直維持貧窮。And the second question we have to ask regarding the price wars between OpenAI and Anthropic is that the more complex profitability paths. Both companies, both OpenAI and Anthropic, incur operational costs amounting to billions annually. The price war complicates efforts to achieve profitability, as lower prices coupled with already unprofitable operations imply a more extended timeline before achieving a profitable status. And the third question is regarding the shifting roles of private and public companies. As privately held entities supported by patient capital, like hedge funds, venture capitals, these companies can prioritize market share over immediate profits. However, once post-IPO, the pressure of quarterly reports, analyst scrutiny, and shareholder expectations will complicate the justification for ongoing substantial subsidies or the heavy capital expenditure on data centers. And that's also what SpaceX Elon Musk faced, as earlier I mentioned above. This situation does not signify a weakening demand for AI, nor does it indicate a slowdown in infrastructure development. Rather, the lower pricing of OpenAI is is indicative of intensified competition among model layers and a demand for high-quality cost performance from clients. In the long run, this is arguably beneficial for the broader AI market and the whole AI industry, particularly in sectors closely related to actual computational resource consumption and energy. Regarding the IPOs of OpenAI and Anthropic, this scenario will serve as a fascinating stress test. The public markets will ultimately assess whether, in a world of constantly evolving models, these companies genuinely merit their lofty valuation. At this time, let me recap some money management skills. Let me teach you some basic management money management thinking framework. 咁杜撚就趁中場又係一個休息時段，就教一教一個新手理財嘅一個思考框架。咁就係一個6層嘅思考框架嘅，就包括從一個市場嘅維度啦，從產業鏈嘅維度啦，仲有從個股嘅維度去思考我哋嘅理財。So the investment methodology was originally articulated by a famous individual referred to as Serenity, white hair stock god, 一位叫做白毛股神嘅 KOL Serenity。 delineates a 6-level framework intended to guide novice investors in the development of our analytical thinking. Serenity's distinction lies in our approach of constructing personal investment thesis through observations of the real world and interdisciplinary connections prior to the release of research reports. 我哋個人理財嘅論文，我哋要做個人理財啦，好重要就係依賴我哋對於現實成個環球世界、現實地球嘅觀察，同埋一啲跨學科嘅接觸啦，一啲跨學科嘅一啲內線人物喺一啲研究報告發表之前。即係喺佢發表佢嘅研究報告之前，呢個亦都反映咗我哋如果要做理財嘅話，我哋需要對於成個宏觀世界要有好深入嘅認知啦，亦都要有跨學科嘅理財嘅底層邏輯同埋一啲跨學科嘅知識啦。While this methodology is inherently complex, challenging to replicate on a large scale, and heavily reliant on personal judgment and experience. The so-called empirical studies. Novices are encouraged to engage in prolonged reasoning and validation as a means to progressively assimilate the framework. So, the 6 levels of this investment framework are as follows. The first level is initially acquire proficiency in standard analysis, fundamental analysis. Initially, learning fundamental analysis involves examining revenue, profit, and market capitalization to determine whether the current valuation is inexpensive based on projection for 2027 and 2028. Serenity has mentioned companies like Samsung Electronics and AOI can initially utilize a comparison of future revenue or profit versus current market value for estimation. 第一層嘅理財嘅思考框架就係從盈利、利潤同埋市值呢3個最簡單嘅指標去做一個初步嘅基本面分析啦。咁就係我哋思考到底佢當前嘅市值對比起佢未來，例如2027年、2028年一個短期嘅利潤或者佢嘅收入做一個比較嘅分析。And the second level is subsequently examine the positioning within the supply chain. Analyzing the position within the supply chain is crucial. One must consider at what tier the company is situated. Is it engaged in materials, substrates, lasers, optical modules, packaging, wafer foundries, EMS, or cloud infrastructure? The dimensions frequently explored by Serenity include IMP, silicon photonics, CPU, storage, like HBM, DRAM, NAND, and the AI server supply chain. 第二步亦都係我哋理財好重要一環，就係我哋要分析我哋嘅供應鏈啦。我哋一定要好清楚咁樣去考慮到一個公司或者我哋一個個體啊，係處於成個供應鏈佔咗邊幾層。And you may also incorporate Jensen Huang's 5-layer cake thinking model. 你都可以去做一次引用黃仁勳嘅5層蛋糕理論。So which level in the supply chain are you in now? Feel free to comment yourself. 到底各位觀眾朋友，你哋而家處於供應鏈嘅邊一層呢？例如你哋而家係整緊一啲光學啦、半導體啊，定係伺服器嘅供應鏈啦？歡迎留言話俾導撚聽啦。And the third layer is we have to identify weak signals that have yet to be integrated into consensus reports. Identifying weak signals which have not yet been incorporated into those consensus reports is essential, such as for RPI, observing a shift in demand from peers purchasing Raspberry Pi or Mac Mini for AI orchestration. For AXTI, inferring a supercycle in optical communication from a bottleneck in IMP substrate supply. In the case of XFAB, deducing possible involvement in a European silicon photonics supply chain from ASE documentation, government data, and the layout of European supply chain. 即係我哋應該要喺一啲有共識嘅研報出之前，我哋就先去理解一個分歧，即係理解無論係業界或者學術界對於某一個產業某一個概念之間嘅分歧。咁好多時頭先亦都講到啦，我哋如果要理財嘅話，仲需要留意各個政府佢哋嘅政策面咯。咁包括大家可以密切追蹤住歐盟佢會批某一啲嘅產業啦，或者佢會唔會出一啲嘅法律去禁止某一啲產業嘅發展咯。咁好多時候一啲歐盟嘅法案其實都同我哋理財息息相關嘅。The fourth layer is transforming weak signals into models, and transforming weak signals into analytical models is very important. Not merely convincing oneself with this narrative is popular, but instead questioning if this comment is indeed constrained by the critical bottleneck. To what potential levels might revenue, market share, and market value rise? For example, if AAOI achieves the revenue scale mentioned for the first half of 2027, would its current market value still be regarded as underestimated? 咁呢個就係將好多從新手或者唔識理財嘅人區分做一啲叫做識少咗理財嘅人嘅一道門檻啦。咁就係好多時我哋應該要量化一樣嘢。咁我舉個例子就係好多唔識理財嘅人，佢哋淨係會知道某一樣嘢好熱門或者好多人提起喎。咁樣佢唔會再去深究落去。咁但係真正區分到你係咪識理財嘅話，我哋係要問一個問題，就係假如佢呢一個法案通過咗，或者假如佢真係作出咗呢個決策，咁佢係唔係佢而家嘅現值個市價係咪可以視為一個低估嘅狀態？咁呢個都係呼應緊我哋第一個問題啦。Or put it simple, are you willing to merge and acquire the whole company with the current market price as an average price? 或者最簡單嘅一個好簡單嘅思考方法就係我哋願唔願意以佢而家嘅市場價格，以佢現價嚟去即係併購晒成間公司啦。And Weebearn, I myself highly appreciate this style of thinking, and we should always think about whether it's worth to merge or acquire a certain company. 獨撚我自己係非常之推崇呢一種思維模式。咁我哋自己平時亦都好應該時刻思考我哋值唔值得以現價去收購或者併購一間公司啦。And the fifth layer is to await market validation. Waiting the market to provide validation is essential. Are financial reports exceeding expectation? Is order visibility improving? Are customer demand, production capacity, subsidies, and analyst assessment of the total addressable market (TAM) starting to align? And so, if you read the Elon Musk proposal under the Elon Musk document SpaceX prospectus, and you may also find that he mentioned the total addressable market (TAM), 即係我哋可以接觸得到嘅市場。咁所謂我啱先講咗理財就係你去管理資源咯，而我哋平時係點樣揾錢嘅咧？我哋揾錢之前亦都要先去思考一下我哋可以揾到幾多錢嘛，就係我哋可以接觸得到個市場個體量。咁呢個就係 TAM 啊。咁例如我假設啦，你係做火箭嘅， 咁你可以接觸到幾多市場咧？咁可能會包含一啲想揾你去用火箭運貨嘅公司啦。Let me speak in English back. Total addressable market is actually a very crucial concept in our personal money management. So, as I always say, money management is about how we allocate resources and how we allocate risk. Whereas the total addressable market give us information about how much money we can make before we start. And so, before you earn any money, it is very important that you analyze the total addressable market beforehand. For example, if you do let me give a simpler case. If you are going to open a bubble tea shop, it may not be a good idea. So, what is the total addressable market? You may think of that is all those people with their money willing to pay for buying milk tea. However, people who have the demand for beverages may not necessarily demand your bubble tea. That is the total addressable market does not mean your own market share, and so that is another story. 我哋揾錢之前啦，你賺到一個收入之前，你可以先你一定要先預測一下你總共接觸到個市場嘅上限係幾多咯。尤其係你一定要做大先至揾到錢，你要揾一啲冇天花板嘅事業。咁但係另一個問題就係市佔嘢係另一個問題啦。例如你開珍珠奶茶鋪，你可能將所有有飲嘢需求嘅人都視作你嘅可接觸到個市場。咁但係需要飲嘢嘅人，佢需唔需要飲你生產嘅珍珠奶茶鋪或者你間鋪頭賣嘅嘢飲啦？咁呢個又係另一個問題。And then the central tenet of Serenity's approach is to hypothesize first, then validate, rather than postponing investment until all reports are final. This method elucidates why she seems to be consistently identify opportunities ahead of others. 呢個亦都係對我自己好推崇嘅理念咯，就係我哋賺錢並唔單止係閱讀一啲報告啊，即係我哋叫做市場閱讀集談。咁我哋除咗閱讀之外，我哋都要做實驗，呢個先至係相輔相成咁樣去揾錢。理財並唔單止只係關乎閱讀，理財係關乎於我哋點樣通過結合理論科學同埋通過實驗嚟去試錯，咁樣去驗證我哋理財嘅假說。咁所以無論 Serenity 或者Kelvin Tsai 佢哋都有一個好好嘅賺錢嘅 approach， 就係佢哋會先做一個賺錢嘅假說，即係我先假設咁樣係咪賺到錢，然後再用個市場去驗證咯。The market will always give you the answer。市場會永遠都會話到俾你聽個答案，即係到底你呢一個方法論或者你呢一個假說係咪揾到錢，而佢並唔會等到所有嘅機構財報都出咗佢先至去閱讀咯，即係唔會齋做閱讀雜談啊。佢會自己真金白銀去做一啲實驗咯。而呢個就係點解呢位白毛股神佢經常都可以遠遠領先其他人去洞察到一啲新嘅機會。即係當個個都出晒財報，個個出晒研報，個個都知嘅時候，咁嗰個就已經唔係機會啦，因為寫研報嗰啲人自己已經買落咗，已經賺到盆滿啦。Acknowledging that this is a high confidence interval is vital. Serenity herself has explicitly stated that her strategy does entail considerable risk. Thus, for novices, the focus should not be on merely differentiating target selections, but on understanding how to dissect investment arguments and identify conditions for interference failure. Recently, the primary source of noise surrounding the silicon photonics sector pertains to discussions regarding the delay of CPU mass production. Serenity asserts that claims of such delays are inaccurate and cites statements from the management of NVIDIA and Light to counter indications of postponements. The erroneous selling pressure resulting from the report regarding the delay has created an optimal buying opportunity. 咁我哋啱先講到賺錢就係要做實驗啦。咁其實我哋同時亦都喺我哋做 hypothesis testing 嘅時候，我哋可以諗一個 confidence interval， 即係如果我哋呢一個假設係啱嘅話，咁就有例如95%佢可能個股價就會落喺呢一個位啦。咁然後我哋都要諗一個情況就係喺咩情況之下我哋會話我哋自己呢個驗證係錯啊，咁就套用翻好似技術分析入邊嘅指示啦，即係我哋做技術分析嘅時候，我哋可能會話當價格跌破某一個資產嘅時候，咁我哋當初買入呢一個股票嘅假設就係錯噶啦。咁如果搬落去基本面分析嘅時候，我哋就要諗一個情況，諗一個諗一個諗一個 CI 呢個 confidence interval， 咁就係如果超出咗呢個範圍嘅話，咁我哋就我哋就會話我哋應該止損啦，即係我哋當初嘅呢個假設係唔啱噶。咁不過通常 null hypothesis 就係講緊個 action， 就係講緊呢樣嘢係零。So it's very important that we have to set a criteria on when or where our initial hypothesis is wrong. Just like in the chain on chain, just like in technical analysis, we may set a stop loss level. So it's like if the price drops below a certain key level or a certain demand zone or a support zone, then we will overthrow our initial hypothesis and we just stop out. And this is the same for money management in fundamental analysis, the money management skills in technical analysis. So we propose an explanation for certain market phenomena, and then our money management should be testable, and it should also satisfy some parsimony. And in fact, we can conduct some statistical tests for money management. So to determine how likely is that the overall effect could be observed if our initial hypothesized relation does not exist. So that is the null hypothesis. The null hypothesis means that there is no such relation. If that likelihood is sufficiently small, like less than 5%, then the existence of a relation may be assumed. Otherwise, we reject our null hypothesis and we can conclude that such a alternative hypothesis is statistically significant. conventional significance level for testing these hypotheses are like 0.05, and the significance level for deciding whether the null hypothesis is rejected. And then we just accept the alternative hypothesis and must be determined in advance. Under such a distribution, your income will be grow to such a level. So if your income actually grow beyond such level, and you may reject your initial hypothesis. Reject the null hypothesis and accept the alternative hypothesis. And that's how the white hair stock god, 白毛股神 Serenity spot so much opportunities to become rich. 揾到咁多可以發到達嘅智慧同埋機遇。Next, let's talk about the WWDC 2026. A conclusion of WWDC 2026 has resulted in a notably subdued discourse within the technology sector, with Apple's stock price experiencing a minor decline following the event. During this session, Apple unveiled a completely re-engineered Siri, which is now powered by the third-generation foundational model AFM3, and has entered into a profound collaboration with Google Gemini, emphasizing privacy and on-device edge processing. 邊緣運算. These developments appear to be quite encouraging. However, the market response has been lackluster. The rationale behind this is straightforward. In an environment where new cutting-edge models are introduced every few weeks, and the tech community is collectively exuberant, Apple's offerings appear excessively pragmatic. Within the realm of capital markets, pragmatic often equates to unexciting. What exactly did Apple present this time? The enhancement of the new Siri largely focuses on addressing previously criticized aspects deemed artificially unintelligent. Following conversational abilities, departing from the monotonous question and answer format, Siri is now capable of engaging in natural back-and-forth conversation, assisting users in brainstorming and document modification. Understanding personal context, Siri can directly extract information from messages, emails, photos, and calendars. For example, if you inquire, what was the restaurant address Amy sent me last week, will independently search through chat records without requiring manual input. And another feature is screen awareness. Siri can now see what is displayed on the user screen, and just like the device control or computer control for a computer. For instance, users can highlight a section of text in an email and command Siri, add this to my calendar. Independent Siri app. This interface resembles that of ChatGPT, supporting text input, voice commands, and file attachments, or synchronizing across all Apple devices via iCloud. Architecturally, Apple has adopted a hybrid approach, where tasks manageable on devices like smartphones or Macs are processed locally and by edge computing. Only when local computational power is insufficient will it resort to private cloud computing. Private cloud computing is a firm assurance of data deletion post-processing, making it inaccessible and private even to Apple. This approach is starkly different from the everything to the cloud methodologies employed by popular Google and OpenAI. Apple's message to users is, we can provide robust AI while safeguarding your privacy. The truth behind the partnership with Google is that WWDC also reveals its details regarding Apple's collaboration with Google Gemini. In essence, Apple's third-generation model AFM3 does not simply adopt Gemini, rather, it learns from it. Apple utilizes Google's leading model to train and refine its own. Just like the distillation model in DeepSeek or like Minimax. Craig Federer underscored that personal data resides securely within Apple's ecosystem, with no curated data accessible to Google. The nature of this collaboration is pragmatic. Apple acknowledges its lack in developing foundational models, and recognizes that partnering with Google is the most efficient way to close the gap. This arrangement preserves Apple's reputation, control over the platform, and privacy, while simultaneously enabling a rapid enhancement of Siri. Max is evolving into the most powerful local AI workstation. Relative to Siri's capabilities in making restaurant reservations, the updates released for developers may represent the core focus of this presentation. Apple endeavors to position the Mac as the world's premier local AI operation terminal. I think probably due to the emergence of OpenCloud and AI agents with computer control. In simpler terms, these technical updates signify that AI assistants, AI agents no longer need to call back headquarters, no longer need those cloud infrastructure. Previously, in order for AI assistants to facilitate tasks, they had to relay data back to cloud servers. Now, Apple has enabled developers to execute a comprehensive AI agent cycle locally on the Mac, allowing the AI to think independently, operate software, and complete tasks. This results in zero latency, the avoidance of cloud computation costs like token fees. It ensures security, connecting multiple Macs to form a supercomputer. Developers can now link several Macs via a Thunderbolt cable to collectively manage the workload of running extensive AI model. Sounds cool, right? It's just like crypto mining with GPU rigs in a decade ago. Apple is capitalizing on its unique hardware advantages, like its unified memory architecture, M4 chips, constructing a declouded local AI environment for developers amid a climate of high cloud computational costs and rising privacy concerns. For small startup teams or researchers who cannot afford or access expensive cloud chips from NVIDIA, utilizing 3 Mac Studios on a desk, like a crypto miner, to run large models represents a compelling practical alternative. What is the market currently unenthusiastic? And though given the depth of foundational positioning, why was Apple's stock price decline? Why has Apple's stock price still declined? Buying on expectations, selling on reality, and the so-called buy the rumor, sell the news. Many of the functions demonstrated were already anticipated and priced in by the market, lacking the wow factor that generates excitement. And the follower label persists. While seeking assistance from Google is astute, it reaffirms to investors the reality that Apple is unable to independently produce top-tier foundational models, and those large language models. Inability to immediately stimulate a replacement frenzy. Wall Street is in search of a compelling reason for consumers to eagerly upgrade their iPhones. Analysts widely agree that although the new series is functional, it does not yet merit a must-have status. Additionally, high hardware prerequisites requiring at least an iPhone 15 Pro and delayed launches in European and Chinese markets, make short-term revenue surges unlikely. The public's narrative seems to be speculation. Currently, 99% of evaluation regarding the new series stem from interpretation of Apple's polished demonstrations. Genuine public testing is expected in summer with a full rollout in autumn. Before the general populace can utilize the system, its performance in real-world applications remain uncertain. Apple is wagering on a different future. If one subscribes to the belief that everyone requires an omniscient cloud-based brain, Apple may appear as a laggard. Conversely, if one believes that future AI should exist quietly, securely, and considerately within one's device, that is known as edge computing, attending to routine tasks, then Apple's hybrid local AI strategy is quietly constructing a formidable barrier to competition through both hardware and the ecosystem. Whether this strategic slow-paced scheme will yield fruitful results will become evident once public testing commences in autumn. In the 2025 accounting year, Apple's capital expenditure is projected at approximately $12.7 billion, which represents only a small fraction of the expenditures by its AI competitors. The combined spending of major competitors is expected to exceed $400 billion in the 2025 year. Apple has also announced a buyback plan amounting to $100 billion. While the AI sector stocks have faced selling pressures due to concerns regarding the spending on infrastructure exceeding $400 billion, Apple's disciplined capital allocation, characterized by reduced infrastructure spending alongside significant shareholder returns, becomes increasingly strategic in the context of these market upheavals. For the 2025 accounting year, Apple's capital expenditure is projected to be around $12.7 billion, which is a very small fraction compared to all those combined expenditures of Microsoft, Alphabet, Meta Platforms, and Amazon, those competitors of Apple, which are anticipated to surpass $400 billion for the same accounting period. And this gap is expected to widen, with Amazon alone projected to allocate approximately $200 billion in capital expenditures this year, requesting about 1 times Apple's recent accounting year expenditures. In remarks regarding the company's performance in the second fiscal quarter, Apple's Chief Financial Officer, Kevin Parag, stated that strong business performance generated over $28 billion in operating cash flow for the March quarter, setting new records for operating cash flow and earnings per share. Apple, headquartered in Cupertino, California, has not overlooked artificial intelligence, actually. Instead, it has opted to finance this initiative through alternative means. The company's research and development expenditure for the 2025 accounting year will reach about $34.6 billion, nearly 3 times its capital expenditures, and this figure has increased by 3% year-over-year in the most recent quarter. At this week's developer conference, WWDC, Apple announced a highly anticipated comprehensive upgrade to Siri, which will be utilizing Alphabet's Gemini model, with reported partnership costs approximating $1 billion annually, set to launch this fall. The contrast in capital allocation strategies becomes markedly evident as AI infrastructure stocks face declines. Oracle has announced plans to raise billions Oracle has announced plans to raise billions in additional financing for its data center construction while achieving record quarterly results. However, its stock suffered a significant double-digit percentage decline. Concurrently, chip stocks also fell, as investors expressed concerns regarding the timing of returns on such expenditures, especially after the concerns over the Federal Reserve. Meanwhile, Apple announced a new 10 billion stock repurchase authorization in April, while raising its dividend by 4%. This quarter represented Apple's best performance ever for the March period, with revenues increasing by 17% to $111 billion and earnings per share increasing by 22%. The implications of share buyback activity amidst commodity pressures is worth our attention. While competitors allocate cash towards those data centers, Apple continues to direct its resources towards shareholders. Nevertheless, the pace of stock buybacks has slowed. Apple repurchased approximately $12.29 billion in stock during the second fiscal quarter, a reduction from the previous quarterly average of $23 billion to $25 billion. Conversely, Meta Platforms and Alphabet reported zero expenditures on stock buybacks in their most recent quarters, with Alphabet further announcing plans to divest $84.75 billion in stock, effectively retracting its long-standing share repurchase operations to fund its AI infra strategy. This reduction in share buyback activity has broader market ramifications. Over the 12 months leading to September 2025, companies in the S&P 500 spent a total of $1.02 trillion on stock buybacks, marking a historical high, with part of this momentum springing from the reductions in corporate tax rates established by the Tax Cuts and Jobs Act of 2017. If ongoing expenditures on AI infrastructure continue to consume this capital, then the earnings growth momentum that underpins the market could potentially wane. This risk is further magnified due to the share price to earnings ratio of the S&P 500 nearing 43, more than double the historical mean of 17.4. The risk associated with a reliance on competitors also requires our attention. Apple's approach carries its own risk. The revamped Siri operates on a model provided by a direct competitor rather than Apple's own proprietary technology. Should AI assistance emergence at the primary interface for device interaction, reliance on Alphabet for this crucial component could prove costly. This competitor has already penetrated the products through which Apple customers engage. The stakes are substantial, given Apple's install base exceeds 2.5 billion active devices. Investors should focus on two primary considerations. First is the acceptance rate of the new Siri version upon its launch this fall, insights of which may emerge from remarks during the subsequent quarterly earnings call, like in the next year. Second is the momentum of the iPhone and services business, whether they can sustain their momentum throughout subsequent quarterly reports. Continued double-digit growth in these two core areas would indicate that customers recognize the effectiveness of Apple's AI strategy, whereas at present, Apple's market capitalization stands at approximately 4.3, maintaining relative stability amidst the AI sell-off. While restraint may seem timid during surges in AI infrastructure stocks, it may equally come to be seen as discipline when the market voices concern regarding the debt burdens and cash expenditures of such spenders, allowing competitors to bear the burden of hundreds of billions in expenditures or debts liabilities while nurturing customer relationships, provided that Apple substantiates its capability to develop outstanding AI experiences, positions the scenarios as a coveted undertaking for most enterprises. So let's take a break now, and in the following session we are going to talk about the Q4 financial report of Oracle, the Nvidia, and also the U.S. Government's Bitcoin strategic reserve in the coming session. Stay tuned. And again, Weebearn is a comprehensive money education platform designed for Weebearn for otakus and teens. We nurture entrepreneurs, capitalists, and investors. If you like to discuss startup ideas and engage in some collaborations or partnerships with other founders or even venture capitalists, you may join our Discord community. And next, let me experiment with one AIGC platform known as HolyGrab AI.